The Investor's Edge series presents Finding Your Edge, How to Win at the Game of Commercial Real Estate Investing. Written by Jeremiah Boucher and narrated by me, Jeremiah Boucher. Part 2, Lessons Learned. This part of the book's going to be about real estate investing. These are going to be the fundamentals of investing. This is more the educational part of the book. It's going to be a little dry, and this is the nuts and bolts of the business. But if you're truly interested in learning about commercial real estate investing, this is everything I got. The 6 Edge principles described in Part 2 are the secrets to my mindset that helped me succeed in the commercial real estate business. These are distilled from what I learned from my failures and what worked for me when I first found success. These Edge principles helped me learn how to conduct myself as a true professional. They also helped me adapt the resources available to me to make deals and get enough income to survive while I was trying to learn the business. Some of these ideas I learned through other teachers and courses, but most came from real-life experiences and mistakes. I'm not an author. I do this business every single day. I learned this stuff, and I want to share it. As I compiled these lessons, I tried to go back to the beginning when I didn't have any knowledge, so I could remember the critical drivers, the motivators, and the key points to make a stronger real estate investor. There was a sequence to my growth. As an example, to first find deals, I had to learn how to recognize and add value to sellers, investors, and properties. This was the beginning of principle number 1, find your value in the deal and find your value in your own skills. The only way I could find deals was by creating relationships with property sellers who weren't listing their properties for sale, but had an interest in selling. This was principle 5. Real estate is a relationship game. Due to the lack of capital, since I had no money, I had to find value in 2 ways: how I leveraged what capital I had in the deal and the value I could offer to partners instead of capital. Initially, this was me going out there, hustling, sourcing, and finding deals. Edge principle 4, never get too high, never get too low, applied in many ways. Emotionally, physically, and strategically. For instance, even when I could negotiate a no-money down deal with seller financing, I still needed capital to close the deal. I had to figure out how to use only what was absolutely needed so I could still have some cash in reserves. Creativity and trading skills, knowledge, or relationships for equity utilize principle number 2, innovate to gain an edge. I creatively structured deals with seller financing, or I negotiated the seller to actually reinvest in the property. This way, I could get more equity. While I was making offers, I had to apply principle 6, trust your instincts, and push forward even during times of extreme uncertainty. During the entire process, I needed to keep my emotions out of it by applying principle 4. Again, never get too high, never get too low. To solve problems and overcome barriers, principle 3, stay the course to win, was absolutely necessary to close the deal. If something about negotiation went south, I had to decide when to walk away. That required going with my intuition, as applied in principle number 6, trust your instincts. If you want to be an active investor, I'm giving you the foundation to go build your own real estate investment company. If you're a passive investor who's looking to invest in a fund or go off and invest in different partnerships, these rules are the foundation of how Patriot Holdings operates. Knowing how a fund is managed will help you choose the fund that gives you the investment results you desire and meets your standards. The 6 Edge principles. Number 1, find your unique value in the deal and your unique skills. Number 2, innovate to gain an edge. You got to do something different. Can't follow the crowd. Number 3, stay the course to win. You got to stick with this shit. This is a long game in real estate, so you got to be committed and you got to be in it for the long haul. Number 4, never get too high, never get too low. Investing is about logic, not about emotion, so you got to know how to control those emotions. Number 5, real estate is a relationship game. It all boils down to this: people need to trust you, and you need to be able to trust others. Number 6, trust your instincts. If you don't believe in yourself, no one else will. You got to go with your gut, go with your instincts, go with your heart. Whatever it is, you got to be able to make a commitment and stick with it. As I started to achieve success, I realized the importance of my mindset in that success. What's not in these principles is the fundamental concept that you've got to enjoy what you're doing. If you hate it, you're not going to stick with it. As you learn what parts of the commercial real estate game you enjoy, you'll see how these principles can help you succeed. For me, it's all about the love of the deal. The hunt for the property, structuring the terms, getting creative. I love to take an idea, a vision I have for an investment, and put it into reality. There's going to be countless hours where you're hovered over a desk baking under fluorescent light. You're going to wonder, why am I doing this? What's my purpose? Everyone has their own purpose. For me, it was not the money. I figured out the things I enjoy the most. Number one is the strategy. I love strategizing and thinking about the different pieces, the different parts of the game, and then how they work together. So that way I can utilize them to enhance value. I can be creative. That's number two, where I can take different pieces of the puzzle and put them together to enhance the value of something, making it more than it originally was, or more than the sum of its parts. And number three, the power to build something from scratch, to create something from nothing. This scrappy part of having nothing and building value and building wealth and creating something that people want in the marketplace. I'm sure you remember an idea about a business or an investment that got you so amped up you couldn't sleep. That's what I'm talking about here. These three things drive me. This is what keeps me going. This is the story behind the story of the money and the influence and the enhancement of success throughout your career. These qualities are the things that really fire me up. You got to find those qualities for you. Edge principle number one. Find your unique value in the deal and find your unique skills. Finding value in commercial real estate covers all aspects. It's not just about knowing a property could generate more net operating income than it currently does right now. There's value in the relationships you create. The equity allocation to partners that add different value to the deal, the financing you can obtain through capital partners or institutions or from the seller, the execution of improvements, and the management of the asset. Most importantly, there's value in what you learn as you're strategizing and then you're realizing real-world results. Some of that value won't be fully recognized in the short term, especially when it comes to relationships or the knowledge and the expertise or mastery over a certain part of the business, but they are a big part of the long game. Value is more than just money in the bank. Here are some important types of value in commercial real estate investing. Number one, the value a property represents to you in terms of the return on investment or the opportunity for forced appreciation. I mean, this is the basics. This is the value add potential that the property actually has. Number two, capital. Can you bring capital to the table, meaning can you get investor equity, the actual partners that are going to put up the cash, or debt, where you have the balance sheet to be able to get a loan from an institution or a bank and be able to get the mortgage or the financing needed to actually close the deal. Number three, management. Money's in the management. Someone needs to manage these assets, and if you have that expertise and you have the resources in your company to bring that to a deal, that adds lots of value. Number four, construction and capital expenditure experience. Someone actually has to go out there and do the work to improve these properties. It's very important to have a partner that understands how this work is done. If you have expertise in construction, that is a huge value add for the team. Number five, analysis and underwriting. Analyzing the deal and understanding the true numbers, how they affect the financing and how they affect investors is critical to understanding how a deal is going to pencil out. As deals get bigger, this is a very important aspect of the transaction, so a partner that can bring this value to the table is essential. Number five, tax strategy. If you're an expert tax strategist, then that is an important part of the real estate partnership process. This is a huge value add. A crucial lesson I learned from Scott Shields' Commercial Academy is about the trade-off between the asset's price and the financing terms. The motto he drilled in my head was, I'll give you your price if you give me my terms. I've said it many times in this book, and this is where I found significant value in many deals. When thinking this way, it allowed me to leverage relationships and expertise. The creativity took place of the capital. So the bottom line for me in finding value, and a place where I now excel, is structuring the deals. I love the creativity available to an investor in this business. The structure of the deal, the strategic partnerships, the creative financing, the different terms you can build, this is the true art of the business. The tools available and the combination of resources you can align allow for so many options to put together a solid winning deal for everybody. An important part of my value-add strategy is capital improvements, meaning the physical improvements to the property. My team now handles the improvements, and we're fully integrated to do this efficiently and rapidly. What I want to teach you is how to recognize the value in an asset and also recognize where there isn't any value. Most often, a lack of value has to do with the economics of an area. If it's a declining population or income or traffic counts, there's really nothing we can do to fix that. Don't buy in these areas and always research the market as part of your due diligence. A lack of value in the deal can also be if the price is too high or the terms just don't work. You've got to know your numbers and know your cutoff point where the value disappears. Whether you want to be actively involved in deal finding, deal making, asset operation, or you want to play a more passive partner role, this has to do with how you like to spend your time. Know what kind of investor you want to be. It's important to know what kind of player you want to be in this game. In this book, I described how I learned to be an active investor, meaning I'm doing hands-on, value-add investing. This is how you maximize your leverage because you're leveraging more than just capital. You're leveraging your knowledge of the business to force appreciation far beyond what a normal up market can produce. The principle is value-add active investing increases the velocity of your money. Whether you want to be an active or passive investor, understanding the strategy of value-add proposition will help you make better decisions about your investments. Be honest with yourself about what type of player you are and who you want to be. Are you willing to put the time in to be an active hands-on investor? Are you attracted to the idea of learning the business, ins and outs, and running the property like a real business, often giving your time and effort to ensure its success? When you succeed, there's no feeling quite like the satisfaction of being successful at this game. You gotta be realistic with your time. If you don't have the time, I've seen too many times people make mistakes where they think they can do too much and they take on too much and they don't know how to say no. There's a lot of work involved with being an active investor and you need to appreciate that time invested in order to do it well. However, if you want passive income to give you the time to do other things, that's good too. And you'll want to keep reading then. As a passive investor, you'll know how to choose better active investor partners. You'll know how to understand this process and really get to know the business. The decisions you make where and how much you want to invest must be backed by solid knowledge. Learning the ins and outs of this business will equip you to make better choices. A passive investor is typically called a retail investor, limited partner, or member of an LLC partnership or shareholder. They're someone that invests in either a crowdfunding platform or wants to place capital in someone else's commercial real estate syndication, which is just a fancy way of saying partnership, and this includes a private equity fund that also owns commercial real estate properties. Passive investors will review the partnership agreement or the private placement memorandum, it's also called a PPM, for a property or a fund and then put that capital into the most favorable deals. Normally, these people are accredited investors and they often hang out with other people who like these investments. I started to learn about these networks such as YPO, which is Young Presidents Organization, or Tiger 21. And these are groups or networking groups that focus on investments and they get exposed to these types of opportunities. What is an accredited investor? The SEC, Securities and Exchange Commission, defines accredited investors as $200,000 in income they earn for the year or $300,000 earned combined as a married couple, or individuals that have at least $1 million in net worth, and this doesn't include the value of their primary residence. Later in the book, we'll learn that you need to validate that your investors are accredited if you are going to advertise any of your funds. Passive investors that invest directly in property also like long-term triple net lease commercial properties such as Dollar Generals, O'Reilly Auto Parts stores. I actually own one of those. Verizon Wireless buildings or Starbucks buildings. These are either land leases or built-to-suit properties where the tenant pays for all the expenses, all the taxes, all the maintenance, and the investor receives an automatic deposit in their account every month. These are passive investments, although there can be some maintenance required by the investor with some of these deals. These are called double net investments, but essentially, the investor does not have to manage the property. These large corporations pay them a check every month to occupy choice locations. Leases are typically long, but after the lease is up, the owner has the ability to renegotiate the lease, or if the tenant leaves, they'd have to go out and find someone else for the space. A passive investor's value to the deal is simply the money or capital that they bring to the transaction. In return, they're not bothered by the details or the challenges of the operations of the business. And I have to tell you, with mobile home parks and self-storage, there is a shitload of details and a lot of issues. They simply receive a monthly or quarterly distribution check from the active investors who are actually managing the assets. And we're the people that are managing those assets, and that's why we get paid for it. Active investors are typically called managing partners, general partners, sponsors, syndicators, or private equity fundraisers. They're all pretty synonymous for the most part. It's a little confusing. These investors are responsible for putting together the entire transaction. They find the deal, negotiate the terms, complete the due diligence, line up the financing, raise or supply the equity capital needed to close the deal, and file the proper paperwork to purchase the property. Then they manage the construction or the improvement projects, they install competent management, oversee all the operational systems, and perform or facilitate the accounting duties. They are also handling all the distributions. If you're an LP, that's all you want. Distributions, these are the profits to the investors. And then they prepare the assets to be sold if it needs to happen, and complete the sale. This is a lot of work, and this is what active sponsors do. Active investors may not personally do all these activities, but ultimately they're responsible for the outcomes. Many times they'll hire third-party vendors for management or construction, yet it's up to them to make sure the investment is executed properly from start to finish. The stakes are higher with this game because you're not only investing and risking your own capital, you could also be personally guaranteeing loans and risking your own credit. And if you're raising money from others, you're risking their money as well. This is a lot of responsibility, and it allows you to reap massive rewards with massive returns that you typically can't get with a passive investor, but it comes with a massive level of responsibility. The 4 levels of investor sophistication. So there's a minimum investment amount for any opportunity, and you need to find opportunities where you can meet the requirements. You also need to know the levels of expertise and sophistication of other investors so you can align your interests and goals with theirs. This concept was described in the first chapter, The Games of Real Estate and Life, along with the approximate ranges of capital that investors at each level may have available to them. There's an old Vegas adage about gambling: if you can't spot the sucker at the table, you're probably the sucker. You don't jump from Little League into the pros without experiencing the learning curve, although you can accelerate your progress with this book or with a good mentor or by taking tons of courses and getting good education. The 4 quarters of the game concept also applies here in terms of your knowledge and experience. Learning to invest is a process, and the 4 quarters discussed earlier may not be specific timeframes in your life in the same way they were for me. Those 4 quarters are more about dividing your career into time frames based on how much experience and knowledge you've acquired. For one person, their first quarter might be 6 months, or for another, it may be a year or 25 years like it was for me. Your first quarter may begin in your 20s, while a late bloomer might start in their 40s or 50s or even later. Regardless, knowing the quarter that you're in will help you know what to focus on in your career at that stage. Even if you're a sophisticated stock investor or business owner, be careful about making the mistake of thinking you can jump into the business and compete with the sharks. The big real estate professionals who own hundreds of millions in assets can eat your lunch if you're not careful. Even if you have the capital to get bigger, I suggest you start small and build up to larger and larger investments. This is building your track record. Get experience with a few $1 million to $3 million deals before you jump right up to a $13 million deal. The concepts are the same, but the price of the mistakes is reduced in the smaller deals. If you want to be an active investor but you don't have any money, then you'll want to pay close attention to the ways you can add value to a deal beyond just capital. Part 1 of the book, I told you some of the stories how I acquired these deals, but in part 2, I'll give you some of the actual no money down strategies. Determining your strategy. Different stages of life require different strategies. Just like sports, there's a time to be focused on offense, and then other times it's more important to be focused on defense. Someone in their first quarter can have a more aggressive, offensive, acquisition-based strategy. meaning they highly leverage a property, they take on more recourse debt, they have minimal reserves and funding in the bank, and putting all their own money and credit on the line. This is what I did in the beginning, just put it all out there. This strategy can work because 1, they don't have many other resources, and 2, they're willing to risk everything they have for the high payoff. You can kind of think of them like the 1990 running Rebel basketball team. Just score a ton of points and forget about a conservative defensive strategy. Run that court. I love that team. Someone who starts their investing career late in life doesn't have the luxury or time on their side and has plenty more to lose. Typically, they have a family to take care of, large overhead, lots of bills, and they're not going to take the time to rebuild their credit if it is destroyed by a loan default. They'll tend to want less leverage on their loans, they'll be hesitant to guarantee any loans or full recourse loans, and they won't want to take on ambitious property rebuilds, management turnarounds, or ground-up construction projects. Later in life, investors will want to have a defensive strategy similar to Dennis Rodman when he's guarding an opponent or controlling the boards. They don't have to do anything too fancy, and they'll do whatever possible to protect the lead that they have. Yeah, I just actually related old investors to Dennis Rodman. After 2 quarters and 20 years in this business, I'm beginning my 3rd quarter of life and of business, and my game plan and team's rock solid. Next, I'm raising more capital and competing with the larger investors. With some assets, I'm taking a defensive position, refinancing them with low interest, 10-year fixed, non-recourse debt. That finally means I get my personal credit off the line, and now I don't have to personally guarantee that loan. This allows me to collect a dependable cash flow every single month and then realize my ultimate goal of riding off in the sunset on that asset. Distributions, baby. Big distributions. For other assets, I have an aggressive offensive strategy developing 50,000 square feet to 80,000 square feet built from the ground up storage facilities in New England markets that I know really well. This is an area where I have decades of background experience, and I feel confident in these markets, but there is no existing cash flow, so it takes a more aggressive demeanor or strategy in order to do this. Understand the alternative commercial real estate asset classes. We're not focusing here on the core 4 traditional commercial real estate investment classes. These consist of office properties, industrial properties, retail centers, or multifamily apartments. The core 4 are more established industries with intense competition, so that makes it very hard to find and execute on true value-add deals. They're out there, it's just very competitive. You want to do what the majority of investors aren't doing to avoid the competition and the higher prices. I learned this from the godfather of real estate, Sam Zell. He is a legend, and his thesis when I heard him speak last year, do what everyone else isn't doing and be ahead of the curve in order to not have that competition. These assets are called alternatives because they have been historically overlooked by larger institutional investors. They were originally owned by mostly individuals with varying degrees of business acumen and were not being competed for by the deep-pocket investors. This situation has started to change over the last 10 years, but significant opportunities still exist. This book's about learning the alternative commercial real estate asset classes called mobile home parks and self-storage facilities. This is what I know, and this is what we're going to focus on. This book isn't about all the ins and outs of what a mobile home park or self-storage facility is. There's much better resources for that. Go to patriotholdings.com/resources. You can see that list of books. They'll get into the nuts and bolts of what you must know to be successful in the business. They'll show you specifics on how to evaluate the properties, the factors that affect the cap rates, and then the small little details to look for when acquiring, owning, and operating quality assets. Narrow your focus. Multiple streams of income are great, but in the beginning, I suggest you don't hop around from asset class to asset class. Obviously, if you're listening to this book, you want to learn about mobile home communities and self-storage facilities. So stick to prospecting and learn the ins and outs of those 2 asset classes if you're in the first 2 quarters of your investing career. Now, as you progress, you may look at investing in triple net deals, or you may want to get into more sophisticated assets like office, apartments, retail, or industrial. However, if you want to move the needle on the value-add deals, mobile home parks and self-storage facilities are still the greatest asset class, in my opinion. finding your value in the commercial real estate investing business. So there's 2 core activities it takes to make it in this business. Number 1, deal sourcing. If you don't have deals, you don't have anything. Number 2, capital raising. There are many other aspects to this business, but without these 2 activities, forget it. You don't have a real estate investment company. Finding the deals is first to get started. Without a quality value-add deal, like I said, you have nothing. These opportunities are usually not listed for sale. You got to hit the ground and go find them. Find these opportunities by creating relationships. This is what I did for a decade. Well, it's going on 2 decades now. You have to hammer the phones. You have to get a list of properties and find out who owns them, talk to them, and then get creative and help solve their problems. Either you do this yourself or you need to partner with someone else to do it. And then the second half of the equation is once you've found the deal, you do have to have the money to actually close on it. Raising capital also requires creating relationships and offering value to the investors who you work with. The 4 components to making a deal. Once you have a property to acquire, you must make the deal. Every successful acquisition has 4 key components no matter what. You can provide value by contributing one of these components in a strategic partnership. Number 1, capital. Provide either the cash or the investor relationships to put up equity in the deal. It's the most ubiquitous of all 4, and it can be the simplest, but in the beginning, raising funds, say your first $1 million for a deal, it's a big daunting task. You either have to be able to do it and convince others to give you that money, or partner with someone else that has that access to capital. Number 2, borrowing ability or credit worthiness. This is about gaining credibility or guaranteeing the loan, which may be potentially secure or unsecured, meaning you either have to put your credit on the line or you have to get a loan and you don't put your credit on the line, it's just your capital that's on the line. Real estate investing is essentially a debt game. Your yield is always the spread between your net operating income and the interest rate, which is the cost of the capital. The value of your property is tied directly to interest rates. You have to have these relationships with banks and institutions that are going to lend you the money. If you don't have those relationships, you need a partner that does. Number 3, relationships. You must gain the trust of either the seller's broker or the seller themselves. This includes finding the property, completing due diligence, negotiating the deal, and executing the PSA, the purchase and sales agreement. This is what I did. You have to go out there and build the relationship to get the deal done. Number 4, experience and credibility. You or your partner must know how to execute on the business plan. Somebody needs to know what they're doing in order to make investors feel secure. This means that they have the knowledge and the ability to complete the construction, the capital improvements, and most importantly, they know how to manage the property effectively. By having this knowledge base and showing it through a solid track record, this acts as a resume, and then it's going to add more opportunities and the ability for you to acquire more properties. Finding value starts with knowing what the components of the deal are, how they're valued, and then figuring out what skills you're good at and how you'll deliver that value to others involved. The different parties are sellers, or the tenants, or investors, and banks. Many investors may have the first 2 parts of the equation, the capital or the borrowing ability. Yet in the beginning, I was limited to the value I could add to the deal because I didn't have the cash, had no experience, had no credit or borrowing ability. So I could create relationships that led to deals, and that's why the investors and the different parties wanted to work with me. Insider value add options. As I learned and I gained experience, I added value with the knowledge to execute on construction and operational improvements. You can also add value through these breakthrough methods that I use to get into the game. Find cheaper third-party contractors on Upwork. They'll help you research your database so you have superior information. Use creative financing techniques to outline how to save taxes for the seller using a seller carry for the entire property or a contract for deed. As you build the relationship, you can show them how this benefits them. You'll make payments to them using the cash flow from the property, and you'll need very little or no capital up front if you structure the terms properly. Utilize seller carry for a portion of the down payment, so the buyer borrows from the seller as a second mortgage at a higher interest rate. In this scenario, you or your partner finance the majority of the deal, usually 80% or more leveraged with a first mortgage through a commercial bank. And then the seller carried mortgage provides most of the down payment, and you'll pay this back using the cash flow from the business. Then you provide the minimum down payment as your capital. This allows you to keep your funds for the value-add plays once you own the property. You need that buffer of capital. It's very important. Another strategic form of seller financing involves their reinvestment in the property at the closing. I love this one. So here's an example of how it works. The seller sells a property to the buyer for $3 million. The seller then reinvests part of their proceeds, say 20% or $600,000 back into the property as a preferred investor. The buyer then needs to finance only $2.4 million for the closing. The seller then gets the depreciation tax benefits just like the investors, and now they're a passive investor. This is contrarian to what people think, but the seller that actually sold the property ended up owning the property after the closing. They were an investor back in their own property, and it gave them the tax benefits and cash flow, and they didn't have to manage the asset anymore. The 5 basic ways to finance a deal. Number 1, all cash. Number 2, seller financing for a first mortgage. 70 to 80% of the purchase price is typical, and then the buyer would come up with the remainder as their own capital or the money that they're investing actually in the deal. When I first started in the business, I didn't understand how this worked. It just means that the seller's foregoing getting some of their cash, and instead they're giving a mortgage out to the buyer so they can make payments over time. Number 3, owner financing a second mortgage. This could be 10% to 30% of the overall capital needed, and this reduces the down payment by the buyer. And then there's typically a first mortgage borrowed from a commercial bank as the senior debt. Number 4, seller reinvestment as a preferred investor. I just described that a minute ago, where the seller reinvests back into the deal and provides your down payment for you, and you go out and get a new mortgage. Number 5, the buyer takes on a master lease and controls the property, paying the seller with the cash flow from the property, and then the buyer has the option to buy at a fixed price during the lease period. This gives you the runway to go out and make the improvements, fix up the asset, add value, and then bring it back to the bank where you can get a better conventional mortgage, paying off that option price that the seller gives you. In the beginning, my goal was to get the seller to carry a mortgage for me because my credit was wiped out, and I didn't let that stop me in the business. However, I did realize I was limited in the deals I could buy individually, since not every seller is interested in seller financing. So with no credit, I had to learn the business and build trust with potential sellers who own these types of properties and met my buying criteria. Those sellers also needed to be open to carrying seller finance first mortgages, typically because they wanted to save on capital gains taxes. The conventional belief is sellers do not want to finance their own properties. This is simply not true. That is not how commercial real estate works. This strategy often helps meet the seller's retirement goals through long-term capital gains tax savings, and it provides them with a secure, passive income, so many are open to this idea. Sometimes they don't fully understand the benefits, and I learned how to explain those clearly. This information is really important because being able to communicate these benefits to sellers is how you create the value-add structure. Traditional brokers will tell you no one wants to do the creative financing or creative structures. It's simply not true, but you need to be able to sell the different parties on the benefits. And in order to do that, you need a deep understanding of how the tax bases work, how the different partnerships work, and how these different creative financing tools work. This is going to give you the knowledge and the power and the credibility to help get some of these challenging deals over the finish line and have the seller or the broker be open to this creativity. Building your database. So what made me different and creative is I got out there and made a lot of connections. In order to do that, I had to go do a lot of research to find out who owns these properties, how old are they, would they want to sell, why would they want to sell, and then I actually had to go make the contacts. So what I did is refine and filter my list. That way I'm only targeting people that probably will meet my criteria. They're getting close to retirement, they have a family that's probably not interested in the business, They're not a sophisticated or professional investor or institution. So my focus out of all those 40,000 different mobile home parks and 40,000 different self-storage facilities was to refine the list and then consistently call the ones that had the highest probability of a deal being created. So in order for you to find deals, you have to cultivate a list. This takes time, it takes energy, it takes resources. I don't know any way to get around it, but that is a strategic value add if you are willing to go out there and go do it. Lead follow-up. You aren't likely to find a motivated, qualified seller the first time you start calling your list. It takes months and years and even decades now for me to continue to find solid investment properties. That's why it's so important to continually follow up until you get the person on the phone, and then you got to stay persistent. It has to be organized. At this stage, we do automated texts, we do automated voicemails, we continue to follow up. You have to make the contacts in order to build that relationship and actually get them on the phone. If you're not willing to do that, you probably won't get an opportunity to buy the deal first. So what do you say once you get them on the phone? Well, when I first started in real estate, I was so nervous about cold calling people and asking them if they were going to sell their property. I worked up this big monster in my head that I was going to get rejected and my life was going to be over, and I was being overdramatic. So really, what I had to do was reframe the situation in my mind and break down the script to being very simple. And that goes with a simple 3-step script. Number 1, I would call them and say, hey, this is Jeremiah Boucher. I own storage units. And number 2, I'm interested in buying more storage units. And number 3, would you ever consider selling in the future? It's that simple. You're not dating anyone's daughter. You're not taking advantage of them. You're not trying to steal their property. You're simply asking if they want to sell it. That's all it takes. Hey, this is Jeremiah. I own some storage units now. I'd like to buy some more. Would you ever consider selling? And then from there, you get the opportunity to open up a conversation. If they do want to sell, that's where you can learn more about their specific property, their specific tax situation, their family situation, and then the business begins. Then you can start to actually solve their problem. I don't want to get into all the little things you need to say on the phone or the information you need to collect, but you can go to jeremiahboucher.com/resources. I'll have a cheat sheet on there. It gives you a script and it gives you an idea of all the pertinent information you need to make a great offer. Explaining seller carry or owner financing. So in commercial real estate, many owners are actually open to the idea of seller financing, but some aren't familiar with it at first. Here's how I explain seller carry or seller finance mortgages to sellers so they see the real benefits. I give them an either-or scenario by asking if they're interested in carrying back a mortgage and taking payments over time, or if they're fine with paying the large capital gains taxes during a sale. So this helps paint the picture so they understand that if they sell, they'd have to pay a large amount of government capital gains taxes, sometimes even state capital gains taxes, and instead, through the seller carrying the financing or holding a mortgage, they can take payments over time and then make interest on their equity. This results in a nice monthly income for them that's passive. They don't need to manage the property anymore, and they don't have to pay the large upfront tax bill. Many properties that need significant capital improvements, or if it's not fully stabilized, meaning there's not a lot of occupancy or income on that property, a bank won't finance that property. So all a seller can do if they really want to sell and get a decent price is provide financing for the buyer, and this will allow them to get more of a premium so the buyer can come in there, do the improvements, execute on the business plan, get the property fully stabilized, and then go back and refinance through a conventional bank. The only other option for the seller is to discount the price if they want to get all cash. The more issues there are with the property or the more challenging the asset class is, the higher probability you're going to be able to structure a creative deal like this because there's not conventional financing available. Making an offer. Once you know the basics of the property, it's time to draft up that offer, and I suggest starting out with a letter of intent. This doesn't cost you a lot of money. It's basically a piece of paper that's non-binding, but it does express what it says. The letter of intent should contain 5 core elements. The offer price, the terms of the agreement, the closing date, the due diligence timeline, and the earnest money deposit. These things are the core fundamentals of any real estate transaction. Once you get it out there on paper, people are going to know if they want to move forward with your offer or not. Now here, you must be able to learn how to accept rejection and take it well. You might as well put out a lot of offers if you want to look at a lot of opportunities. Some people will come back and reject you gracefully. Others will get offended and get angry. I'll cover the actual negotiation process in principle number 4, but this gets the ball rolling. Finding markets for your investing. I'm not going to get in too much detail with this, but you do need to buy real estate in good locations. What's the cardinal rule? Location, location, location. So you want to be in markets with jobs. There needs to be decent housing, and it can't be in the middle of nowhere. You're going to need markets with shopping centers, hospitals, schools, airports, colleges, military, food manufacturing, and industries that will continue to grow. You do not want to be in a declining area without any economic growth. It's hard to turn properties around where there's just no income in the area. If you want to work with really rough properties, then you might have to choose crime, vandalism, drugs, high rates of payment delinquency. That's another part of the business. I dealt with that part of the business. You got to work hard to get those properties turned around, but you got to know what you're getting into. Recognizing value. If this business is your vehicle to help you achieve your goals, then here are some questions you should start asking yourself to find value in what you're looking for. My answers and then the numbers that worked for me follow each question, and then you'll understand what my investment criteria is. Number 1, what size of the asset do I need to buy for the income I'm looking for? A big mistake for beginner investors is they buy too small of properties, and those properties actually can't meet their goals. You're just spinning your wheels and you want to get in the business, but there is a critical mass you must hit with how much income that property can generate so you have enough money to actually distribute to you and your partners. Don't buy really tiny properties. For mobile home parks, for me, it has to have at least 50 lots, ideally 100 or more, and for storage, it can't have less than 20,000 square feet or it's really a waste of time. Plus, you got to be able to expand and add more value so there's enough profit to actually distribute. Number 2, what areas of the country or locations should I look in? This is pretty subjective. Everyone has their own criteria. I like to be in the Northeast, the Midwest, the West, but I've invested all over the country. This is specific to you and what you want based on your lifestyle, where you want to travel, and then based on economic trends. Number 3, what income can this asset generate? This ties in with how much size. So if you have a certain size of property, then it's going to be able to generate a certain amount of monthly income. These assets need to at least have $20,000 a month in income, and you have to get it to over $30,000 a month in income to have enough profit left over. I highly suggest this, and if you're going to buy a smaller asset, make sure it's around other assets in the area so you can combine those management costs and that management effort. So that way you have one larger asset that generates the amount of income that's going to meet your financial goals. Number 4, what's a typical expense ratio? So you want to look at a property's expenses right out of the gate, and if it's more than a third for these assets, then you got to really look closely at what's going on the expenses. If the expenses are high, can you influence them and reduce them? If not, then you must be careful when you're buying because it might not give it the profit you're looking for. Number 6, what would be the maximum price I can pay for the deal? In the beginning, you need to know how much money you can raise and how much credit you have access to, because if you go out and look for big deals and you can't take them down, you might be wasting your time. So have a reasonable business plan on how you're going to be able to close on these properties. You need cash and you need financing. Number 7, how am I going to attract partners and split up the ownership of the deal? In the beginning, I did very simple partnership structures. The capital or money partners that contribute all of the cash get 50%, and I would get 50% for finding, managing, financing the deal. The structure works where the capital partners get paid back first, all the cash flow goes to them, and then after they got their money back, then we split up the capital 50-50. This is the most basic structure there is, and you can find more about partnership structures and documents on patriotholdings.com/resources. I'll share with you my different partnership structures and the forms and documents associated. Evaluating the local market. So once you found a good regional market, you know where you want to invest. In storage specifically, it's critical to evaluate the market around you. This is typically the 1 mile, the 3 mile, the 5 mile, and sometimes the 10 miles around your storage facility. I'm not going to get into the little nuances of all the different attributes of the markets that we want to invest in, but you need to remember storage is all about a market within a market. The competition is your worst enemy. So if there's a lot of other storage facilities in that market, be careful doing business there because there's too much competition. You're not going to be able to keep your storage facility full. If you want a full list of our criteria of what makes a great market, go to patriotholdings.com/criteria. Value drivers. If you're purchasing an existing storage or a mobile home park, once you find the property, adding value includes making improvements in the following areas. Number 1, physical improvements. Number 2, operational or management improvements. And number 3, financial improvements. You must know how to make the improvements and what they will cost. These are the levers that dramatically force appreciation in the asset. Unlike residential property, you don't have to wait for the market to go up. You can make these improvements and increase the value of the property significantly. What this does is it drives the key metric of net operating income. Tattoo this somewhere on yourself if you have to. This is what I tell my staff. NOI, or net operating income, is how you keep score of each asset. It is the number one value driver of commercial real estate. If you're in real estate, you already know this. Income minus expenses equals the net operating income. So it's what is the return of the asset without any debt on it? What is left over? What is that profit distribution there if you didn't have any debt on the asset? So in the corporate world, NOI is synonymous to the EBITDA, the earnings before interest, taxes, depreciation, and amortization. You win and lose by this number. You must be fanatic about finding and monitoring this number. When acquiring a property, or when you're reviewing your trailing 12 financial statements, or when you're reviewing an asset's performance during your monthly management meetings, when you get ready to sell or refinance the asset, this is the formula that actually calculates the value. Because in commercial real estate, this is what people are buying. They're buying a consistent stream of income generated by tenants paying the rent to occupy the property. The more secure this stream of income is, the more the investor buying it is willing to pay. So knowing how much operating income a property will generate and whether it's performing well requires knowing its maximum potential income and then where the property currently is in comparison to that. What the seller tells you during your initial conversation is often very different from the actual numbers you discovered during the due diligence. And this is your job. You need to look at where is the net operating income today, or where is the property performing right now, and then where's the income potential? Where can the net operating income go to? This is the work that you're putting into the property, and this is how you drive that value by increasing the net operating income. Understanding capitalization rates, also known as cap rates. So if you're in real estate or commercial real estate, you probably already know what this is. But to a lot of beginning investors, they don't know what it is, and it's really important to understand the fundamental concept of what a cap rate is. So the formula for a cap rate is the net operating income divided by the purchase price. So a capitalization rate is the measurement of a return a property will generate without any debt on it. So at the end of the day, whatever profit that this property distributes, you divide that by the purchase price, and that's going to be the cap rate. A Chick-fil-A on a 20-year ground lease near my office on Flamingo in Las Vegas, Nevada, might be valued at a 4.5% cap rate. This means if the corporate franchisee guaranteed location paid $10,000 a month, triple net or absolute net, meaning they paid all the taxes, the insurance, the maintenance, any expense, then the property would be valued like this. $120,000 would be the annual net operating income. You would divide that by the return or the cap rate that the buyer would be willing to accept, and that will give you the total purchase price that buyer would be willing to pay. In this case, it would be $2.67 million. Let's say a Bank of America down the road has the same 20-year lease term, and it's trading at a 6% cap rate and generating the same net operating income. So that same $120,000 a year in net operating income to the investor, divided by what they would want as a return from Bank of America's lease, that 6%, the cap rate would give you a price of $2 million. So the investment market values the dependability and reliability of people eating chicken sandwiches more than it does people going to a Bank of America and continuing to do their personal or business banking. And they're willing to pay for that. So in the eyes of the investment market, Chick-fil-A is a much safer investment than Bank of America, and that reflects on the value of the property and the cap rate. Be aware of market trends. So we all know the COVID-19 pandemic forced companies to change the way they do business and require employees to work from home, reducing the need for traditional office space. As a result, the demand for and the value of commercial office space definitely took a hit. The future demand for these assets has been in flux and can't really be predicted because no one knows if they're going to be in the same amount of demand as they were before. This will affect the cap rate and the value the market places on those assets. Now, Amazon.com's been taking over the retail world for years now, closing the doors on several big box chains, we've all seen it, Kmart and many others, and destroying the typical large shopping mall center property values. These used to be rock-solid investments in the retail space. The resulting retail apocalypse has turned the traditional core commercial real estate industry upside down. For the last 100 years, the rock-solid investments were the core four: office, retail, industrial, multifamily. But no more. Industrial and multifamilies being overbid and very little yield is left on those asset classes. So we're seeing millions of dollars of institutional capital flying into niche commercial real estate spaces like mobile home parks and self-storage facilities. These quality assets have been trading now in high 5s or 6 cap rates, which has been an all-time high. This is a far cry from the past when the subpar, the older mobile home parks, were actually trading at 10 caps 15 years ago, and storage facilities were at 7 to 8.5 caps. Private equity companies have been looking for these overlooked income-producing assets in non-traditional businesses for years. They've acquired profitable dental offices, funeral homes, food production companies, tech companies, and cold storage businesses, and then they roll them up into a portfolio and sold them to public companies for huge profits. It's a form of consolidation, and we're seeing that right now in both the mobile home and the self-storage space. Plan your strategy to take advantage of the trends. Billions of dollars of capital are entering the space, driving up these mobile home and self-storage values. Why is this exciting for you and me? Because for the most part, these large investors don't have the bandwidth, the time, the staff, or the inclination or desire to go out and acquire off-market, smaller, non-performing assets from unsophisticated mom-and-pop owners. These value-add opportunities need work, a lot of it. Sometimes a complete revamp of the property and its management operations. We routinely install or implement a new accounting system, we raise the rents on existing tenants, and then we construct new units on any additional property nearby or adjoining the property. This is way too much work for the big investors. They're financial engineers. They raise hundreds of millions, if not billions of dollars in investment funds, and they find quality assets to purchase. They make money on fees they charge to investors and by implementing long-term rent increases and incremental cost-cutting measures through economies of scale by owning tens of thousands, if not hundreds of thousands of units. These are the institutions or the funds that buy large portfolios. My strategy is to wedge my business in the middle of this formula. My deals are sourced from mid-size, meaning $1 million to $10 million, non-performing or average performing real estate assets, and these assets are ran like businesses, and they're mom and pop owners of 4 or less properties. My company's nimble and creative. We have a value-add approach and strategy. It's a niche commercial real estate investment company that can acquire a property for a fair price based on the business's actual numbers. We have the resources and expertise to upgrade it, improve the asset's appeal to its customers, and then increase that magic number, the net operating income, and then resulting in a value increase over a period of years. Now, when the asset's shiny and humming on all cylinders, there's not a whole lot I can do. There's no way I can place the capital and get the returns needed based on our value-add approach. So what I focus on is the inefficiencies in these assets. And then once we do create the efficiencies in the asset and force the appreciation, we decide to either sell the asset or refinance and continue to receive a revenue stream. Once you own the property, there are 4 ways you can add value. When you're evaluating a project, you need to look at the opportunities to apply these 4 approaches. If it's already beautiful and fully occupied, there's no improvement you can make, and that's not a value-add opportunity. It may be a great income-producing asset with a steady return, better than the stock market, but we specifically want to force appreciation. Look for the potential for operations and capital expenditure improvements in these 4 areas. Number 1, improving the property itself. This is physically, making it more appealing. Number 2, occupancy. You got to get the tenants in there. Number 3, rental income management, meaning you have to raise rents to the market values. Number 4, decrease expenses. Cut the fat, get rid of any useless expenses on the property. There are operational efficiencies you can improve, and then there's the heavy lifting, such as the capital improvements or the infrastructure, meaning you're adding more units or spaces or repaving or rebuilding part of the property. Property improvements start with what's already there. So make the physical improvements. You want to clean it, paint it, pave it, light it, make it more pleasing. Make sure it's a place your mother or grandmother would feel safe there. This is common sense, but it goes a long way, and people actually forget to do the small things. Improving occupancy starts with filling existing vacancies. Adding or building units is the hardest thing to do, so don't underestimate the time it takes to do it. Operational efficiencies come down to your management teams and systems. So look for the mismanaged operations for a great value-add opportunity. Specifically, if there's bad collections or there's a lot of vacancies. This is the opportunity in the space. When these owners mismanage the assets, this is a good thing. You would like to come in there and improve the management, improve the asset. You want issues on the asset, and that's going to create the opportunity for the large returns. When we come in, first we want to improve collections and then put in new management systems to make sure people who aren't paying start to pay. Once you have people paying, then you can increase rents. Next, we make sure we have a good staff, a good team. They need to be pleasant. They need to have good customer service skills. This is a service business, even if it's real estate. Dictating your strategy, your buying criteria for mobile home parks and self-storage properties. So here are some of the buying rules that I use when I'm going to buy a property, and I have to stick to these fundamentals. If I stray too far, I make stupid mistakes. Number 1, must be a value-add deal. This is the single most important aspect of the velocity of money. If you can't add value to a deal, your capital is going to be stuck in it, and then you're not going to get the returns you want from that capital. So if we can't add value, we don't want to do the deal. Rule number 2, it must be sizable. It must meet that minimum size criteria, or there's too much opportunity cost and we're wasting our time doing small deals. No more small deals. Number 3, get the best financing possible. We work with a loan broker and we get lenders to compete with themselves. Typically, there's 3 to 5 banks that will be vying for the loan, and they're going to compete to give us the best terms. So don't take the first term sheet. Have your lenders compete and get the best financing. It affects the value. Number 4, the location can't be fixed. It has to be right from the beginning. Destiny is in the demographics. Great real estate markets are correlated with jobs. If there's a lot of good jobs, that's going to be a good real estate market. You want to be close to freeways, high major traffic count areas, in close proximity to retailers, chain restaurants, hospitals, and airports. You want to be near metropolitan cities, but if you are an hour or 2 hours away, that's fine. Suburban and tertiary markets still have a lot of value. Combining business and pleasure. So, like I said, my family's from New England. I love the landscape there. I love the summertime, and I would always go look at properties when I was out there. So right now, I'm building a house there while I write this book. So I would say think of places that you already go on vacation, or if you visit family members or in-laws, you can start prospecting those owners in those areas. And then I find that they're less competitive, especially ones that have lakes, mountains, seacoast, where it's more destination tourist-based. We've done a good job building storage in these markets, and there's been a huge demand. But the point here is, if you're already going somewhere, look at the real estate. There could be a lot of value hidden to places you're already going, and you already love being there, and it's a great lifestyle. Rule 5, property age. The older it is, the bigger the capital expenditures. This is an important rule, and I prefer to purchase buildings that were built after the year 1980. Buildings that are constructed before 1980, they could have environmental issues, they could have asbestos or lead contamination, and also older buildings aren't compliant with the ADA, the American Disabilities Act. So a lot of times, if you buy these older buildings, the building department or inspectors will come in and make you bring it up to code. So for me, no old mill buildings in the Northeast or in New England. I am doing a big box conversion where we're considering converting an old Kmart to a storage facility, but that property was built after 1980, so there's a better chance that it won't have a lot of that major deferred maintenance. This is an important point to focus on because a lot of new investors think they can take on bigger projects than they actually can. Old buildings can be a nightmare, I'm telling you. So if you're new to this space, don't take on these old conversion projects or rebuilding an older building from the early 1900s into apartments or offices or any type of commercial use. It's very difficult. You need to be an expert. Ideally, you should be close by because each municipality or town will have their own regulations on these older buildings. How to add value once you own the property. Value add tips, property improvements. Here are the quick formulas to add value to mobile home parks and self-storage facilities. It's pretty basic here, but this is the quickest way to increase the value of the property itself and the amount of cash flow that you receive. When you buy a mobile home park, the number one thing you want to do is make sure you increase the lot rents to the market rent. Most of these owners don't raise the rents because they don't want to deal with the tenants, so that's number one. Number two, you need to bill back the utilities. When the tenant isn't paying for their own water or sewer or trash, they abuse it. They don't care if they have a water leak because they're not paying for it. So as soon as you install a water meter on these units and they're responsible for their own water bill and their own sewer bill and their own trash bill, they tend to be more conservative and reduce that bill. And it increases a lot of value on the bottom line for the investment group. Self-storage facilities. Number one, you want to increase the rents. A lot of times owners will not increase their rents and they'll be well below market. Now only do this if there's a small amount of vacancy. If your facility's half empty, then you don't want to increase the rents. But if you are fully stabilized, around 90% more occupied, you have to raise the rents to get them to market. Number two, expansion. If you can add more units, do it. This will help increase the overall size and the occupancy of the project. There's no better way to add value to these storage facilities to build on existing land that you already have. Physical occupancy versus economic occupancy. So this is an important point to understand when buying commercial property. There's two different ways to gauge occupancy. The physical occupancy can be expressed in a lot of different ways, but it's simply the number of units rented as a percentage of the total available rentable space. Or it could be the total square footage rented divided by the total available rentable space. That will tell you how many physically people are occupying that entire property. Now, economic occupancy, that reveals any discounts, concessions, credit losses, people not paying. So what you do is you tally up the standard rates, whatever you're charging everyone, and that's going to give you your gross potential income. And then you divide it by how much you actually collected. So that's going to give you the percentage of economic occupancy that you have. So if your total property is supposed to collect $10,000 in a month and you only collect $9,000, your economic occupancy is 90%. So one thing I look out for is if your physical occupancy is more than 10% higher than your economic occupancy rate, then there's an indicator of a problem. Most likely the manager's either pocketing some money or the owner's really not pushing to collect any money. And you have a lot of people at that property who actually aren't paying rent. So this could be an opportunity if you come in and buy that property, as long as you know they physically are there. Then the plan is to go charge them and actually collect that rent or get them out of there and get the opportunity to release that space at the higher rent. Remember, money's in the management. So your management team, this is where they create real value. Get out the deadbeats, get people in that pay, and that creates instant value. Now, before you start raising all these rents, making cosmetic improvements is important. Nobody wants to pay premium rent in a shithole. It's important to see this before you buy the property and understand that budget, and then also make those improvements quickly so the residents feel a pride of ownership, or your tenants or customers feel like they have a good property that they're leasing at or they're occupying. Do the basics first. Clean it up. It's self-evident. Improve the landscaping. Add professional signage. I can't tell you how important this is. Do you ever go into a restaurant where the front sign looks like someone hand drew it? No. Your perception of the business is the sign. So pay extra for the signage. It makes all the difference and makes you look like a big corporation and very professional. Next, improve the roads. You know my story now, and you knew I grew up paving, so I love paving. And you'd be surprised. Every time you buy a new community, you go in there, you grind out the asphalt, and you put in freshly paved roads. It makes such a difference, and people feel a pride of ownership in the community. They feel taken care of, that you actually did something significant, and it makes the aesthetics, the feel of the place 100 times better. And then also, on the storage facilities, my partners originally battled me on this, but you do not want muddy gravel streets. This is a mess in the wintertime in the Northeast. I would suggest bite the bullet, pave the roads. Just because you don't get an uptick in rents immediately, it completely changes the perception of the facility. This allows you to command those higher rents. Improve the lighting. Nobody wants to go store their stuff at a haunted house. Lighting makes such a difference. If your mother or grandmother does not feel comfortable there, you have bad lighting. Now, there's lighting restrictions in different towns, and you want to make sure you don't break those restrictions. But I would lean to the side of more lighting than less. Invest in some lighting, get an electrician there, and this makes a huge difference on the feel of the community or the facility. Add cameras. People think twice of doing nefarious behavior if a camera's watching them. So even if it's the perception of safety, it creates safety, and people feel safer when they see them. And you can catch people if they're doing crazy stuff around your units. We've had some really wild stories. For some reason, we had a guy go into the bathroom all over our storage units, number 2, and it was disgusting. So we caught the guy and told him to get the hell out of there. Cameras are good. Add a dog park, playground, a community reader board, or new mailboxes. At the entrance of the property at a mobile home park, people like to see what's going on in the community, put a newsletter, have a playground. This makes people feel comfortable and taken care of, and it's a nice amenity to add to your community. These little extras go a long way. Offer to paint and skirt the worst-looking homes. Now, this is a little creative, and what I mean by this is when you buy a mobile home park, you typically don't own the mobile homes, but if you reach out a helping hand and you bite the bullet and you help pressure wash and you paint their homes and you offer to give them new skirting so the edges of the home look nice and clean, it looks like more of a single-family home, and you're improving their property, and they really appreciate that. And overall, the big picture, it completely changes the aesthetics of the community. where now you actually look like a nice community. It's safe. People want to live there. But if everyone has a really rough, dingy, moldy, beat up home with a bunch of junk all over their yards, nobody wants to live there. So invest a little money and help these people out, and it'll go a long way with goodwill and the value of the community. There's many more ways to add value or increase the income, but I don't want to get into that here in the audiobook. Go buy the physical book and you can read the playbook. But one important point is cash flow is king. To execute on this value add strategy, you need to know the cost of these items and make sure you budget it up front. Secondly, you need to know your break-even point, so that way you know you're hitting your investor projections, and more importantly, you're paying the debt. That is number one, and anything above that will then give you cash flow that you can distribute to your investors. But what you want to do is know that simple number. When do we break even on this project? And then communicate it to your management team and to your ownership team. We have to hit 82% occupancy before we break even. Typically, we like to hit 55 or 60% before we break even, max. But once you know that number, you all have a goal to work towards. And then that way you feel safe that you're going to be able to cover the debt on that asset. Last value add tip, be vigilant on expenses. My partner, Tim, he's maniacal about what we're spending on every property. This is critical to look at these items. You never know where you could be getting robbed. Certain vendors will overbill you. Property taxes continue to be increased if you don't appeal them. Snow plowing can get out of control if you don't get multiple bids. And overall, money will go down the drain if you aren't constantly looking at your expenses. The goal in this game is to reduce them as much as possible. Now, don't be hasty and fire all your employees, but you do want to be cognizant of what is your expense ratio. That is critical. And in this game, if you can be under 35%, you're doing a great job. Now, as I record this, it's 2023, and the storage industry is going through a transition. Some of these smaller facilities in these tertiary or rural markets, they're getting remotely managed. And this trend is actually translating across the entire industry, where within the next 5 years, I foresee all storage facilities being remotely managed. Reason being, the physical staff or employees are quite expensive. And now the technology's there. After COVID, the consumer doesn't mind not dealing with a real person, signing the lease over their phone, putting their credit card in their phone, clicking on a QR code, and never seeing anyone in the actual office. This is exciting for a few reasons. Number one, it's going to reduce expenses and create a lot of profitability for our portfolio and anyone who owns these types of storages. Two, it allows you to go scale faster. We can go out and buy more of these smaller facilities without needing all that manpower. And then three, what I really think it's going to do is bring in the big institutions, the private equity firms, the public REITs like Public Storage and Extra Space and Life Storage. They're going to now utilize this remote management model, and that's going to open up the door to come in and buy all these little facilities or these portfolios of 50 properties of little facilities, and they're going to want to put them under their big corporate umbrella. This is the big strategy for me. Continue to buy a lot of these smaller facilities, upgrade the technology, improve the physical improvements, improve the cash flow, and make it appealing to one of these huge institutional buyers to pay a premium for that entire portfolio and get that big exit, baby. Chapter takeaways. Edge Principle 1 is finding your value in the deal, what makes you unique, what makes you different in this business, and then you must build a strategy around your strengths. You need to be an expert at recognizing value in properties. This is important that you can see an asset, understand it clearly, be an expert, and then know how to turn on that value for that unique piece of property. This takes time to have that vision, but this is where professional investors spot opportunities others can't see. Value in business and in real estate is more than just money in the bank. True value is about solving other people's problems, offering specialized knowledge or a skill or expertise that others can't do, building lasting relationships. This is the foundation of success in this industry, and it compounds over time. The better you get, the more you master this, the more relationships you acquire, the more successful you become over decades. Operational efficiencies. Operational efficiencies come down to your management team and systems. So put time into the management. Remember, I'll say it again, money is in the management. Look for mismanaged operations for great value-add opportunities, specifically where owners are not collecting from renters. Collections and vacancies are the easiest lift and create the most value with the least amount of work. Focus on that physical versus economic occupancy and then fix it. Lastly, be aware of market trends. Location, location, location. This affects value of these assets you want to invest in. So understand the market that you're investing in. Understand the competition strategy and who the competition is. That way you can find your own niche without competing head-to-head with all the big players. Remember what the godfather of real estate tells us, Sam Zell, competition is good for you, but it's not good for me. So get in markets where there's barrier to entry or there's no competition, and then once you get a foothold there first, you already have an advantage on everyone else that's chasing on your coattails because they came late to the game, to the trend. That's why I liked older mobile home parks in rural areas. That's why I like small storage facilities in suburban and tertiary markets. That's why I like small bay industrial in the suburbs. Everyone chased these trends after they already became successful, so go identify a trend and go do it first. And lastly, there's long-term value in continuing to maintain and cultivate a database. This is simple, but I'm going to hammer this fact. In real estate, your deal flow is only as good as your database. So build these relationships, get the data, know your markets, and continue to focus on building this list because this is your only proprietary advantage. Edge principle number 2, innovate to gain an edge. Be different, be creative. The creative aspect of commercial real estate is what fires me right up. This is what I love the most. I didn't have the resources most people leverage for their success in real estate: capital, credit, connections, experience. I didn't let it stop me. I found other ways to do this, and in doing so, I found my true advantage or my edge in the business. So as that Michael Jordan quoted earlier in the book, I turned my weaknesses into strengths. I didn't have a choice other than just to quit, and I wasn't going to do that, so I wasn't afraid to try things differently. Commercial real estate is the perfect place to be creative in business. There's so many possibilities and different directions to go. We're going to go over that in this chapter. Your unique edge may be different than mine, and that's okay. The principle's about discovering your own strengths and then using that to gain an edge against the competition. That way you have an advantage in the market. Once you discovered where you can outcompete or otherwise avoid that competition, believe in those strengths, leverage them to the max, do it consistently, and that's going to give you that long-term success. Don't assume all sellers want the same thing. You might think sellers only want top dollar and all cash for their deal, but that's just one part of the equation. There are many motivating factors for people who are selling. People need to save on taxes. They got to get out of partnerships. They get divorced. They get sick, and they have to sell. And when a seller's motivated, they're willing to wait to maximize the value or get the highest price. That's why they're willing to be creative. This is where you get to really have fun with the negotiating. Knowing what is motivating to the seller is critical. You have to listen. So what made me different and creative? Well, first, it was really I didn't care what I looked like. I let my ego go. I started buying and owning old, rundown mobile home parks and kind of crappy-looking storage facilities in little towns all over America. Creativity is driven by finding value using knowledge and skills that can take place of the capital. Being different and creative was really about finding my own edge, my advantage in the game. So how did I beat the competition? Well, one, I found a niche in that asset class and I found something that was undervalued. Two, I committed to the strategy of doing things differently, calling these people direct, applying all my energy, effort aggressively to getting out there and finding good deals. I didn't sit back and wait. I made things happen. And I also reduced my ego. I lived humble and frugal. I drove an average car. I wore average clothes. I lived in a small apartment. I lived in someone's house for free for a while, and they didn't even know I was there. But I got my ego out of the way. I completely said, fuck looking flashy. I don't care what I look like. Egos and superficiality are ridiculous. All I care about is becoming financially free and being a master of my craft. A critical piece to this was I kept the process as simple as possible for the seller. If we're buying a property, I was not going to get hung up and have all these little battles about prorations or closing costs or maintenance issues. And I noticed a lot of my partners or other investors would get hung up on this. Let it go. Let the small stuff go. Keep my eye on the prize, win the war, lose a few little battles about little things that don't matter, and close the deal and make it as smooth as possible for the seller. I gave these people a lot of respect, yes sir or yes ma'am, and I made it as easy as possible. I did whatever they asked me to do as long as it was in line with the original agreement in terms of the price and terms. Anything outside of that, I just let them have it, and I got the deal done, and everybody was really happy. To accelerate my learning, I went out and found partners who had money, experience, credit, and then I brought them deals, value-add good deals first, and I learned from them. I wasn't greedy. I was working to learn, not to earn. These relationships fit in where I was at that stage in my career, and they worked out well because eventually I could go out and buy my own deals and build my own company and realize my own vision. But I had to sacrifice in the short term, and then ultimately what it did is it built me the right mindset so I can go out and do this on my own. I wasn't dependent on anyone. Funding a deal. It's all about the money. You got to have the money or you can't do the deals. There's plenty of opportunities for creativity in how you obtain funding for a deal, and relationships are the underpinning of it all. Ideally, when you're starting out, some of your main creative options are obviously the seller financing the deal or developing partnerships to raise capital. What I think is really exciting in real estate is the GP-LP partnership structure. This is a beautiful thing in American business. Learning how to structure these partnerships, they're LLC partnerships where you have a general partner that runs the deal and limited partners that put up all the capital. It's the foundation of capitalism and entrepreneurship, in my opinion. There's a great book by Gary Rappaport. It's called Investing in Retail Properties. And what he does is explains in detail how to structure these commercial real estate partnerships. This is essential to knowing how to raise money and how to get that money to close these deals. So aside from the paperwork, the power of relationships is the cornerstone theme of this book. The connections, the relationships, what you create conducting yourself in a straightforward and considerate way where you're straight up, you're direct, you offer value to other people, you're not selfish. This will enable your career. I keep saying this and it's important enough to repeat. You're only as good as your word. Your character is everything in this business, and you must continually stand behind that word and do what you say. And if you can't, be upfront and tell investors you can't do it. But this will give you more than enough opportunities to raise the capital you need or to get sellers to be creative in their financing structures. The anatomy of a no money down deal. So when everyone starts out real estate, they typically ask, okay, how do I do this business if I don't have a lot of money? And in the written book, I have a graph that shows the capital stack on how you would get funding for the deal. And there's some creative ways and some conventional ways to do it. Go to patriotholdings.com/resources. We'll show you the list of different creative structures and the different capital stack graphs so you get a better idea how to fund your own deals. So what I mean by no money down does not exactly mean zero cash will be needed to complete the deal. It means that you don't need a down payment or only a minimal down payment in order to close. You can use other people's money, meaning investors. You can use seller financing. You can use conventional lending, or you can even do a master lease. And you can sometimes use a combination of all of these. So here are the seller financing options. I know we've mentioned this in the last chapter, but they are the foundation for many creative financing strategies. First, you have to identify when the seller would have a situation where he'd want a seller finance or when they want to reduce capital gains taxes. That way you can help solve their problem. And we went over this before, but they might have deferred maintenance they don't want to put up at the property. They might not want to pay any taxes, or they might want a steady stream of income that's secure. Owner financing works for this, but you need to listen to those problems, pick up on it, and then offer some of these solutions and communicate them effectively. So number one, an owner finance first mortgage. This is pretty simple. This is where the owner actually finances the property. And what that means is they don't take all the cash up front. So if you're paying them $1 million for the property, they would be foregoing part of that and taking those payments over time. So you'd pay them a down payment. They would receive the rest of their gain with payments over time, and they would be getting interest on that equity on those payments. There's another way to structure owner financing deals where you can actually get a contract for deed. Now, this is different than a first mortgage being recorded against the property, where you actually transfer the deed into the buyer's name. A contract for deed means that you have a contract that you record on the title, but you don't actually transfer the ownership to the buyer until they make their final payment. So it's a little less secure for the buyer when they're buying a property, but it gives the owner more protection that they don't have to go through the foreclosure process if the buyer doesn't pay the payments. You can go to patriotholdings.com/resources and pull up our forms, and you'll see the difference between owner financing and contract for deeds. Number two, a conventional first mortgage with a traditional bank, and then owner financing as a second mortgage behind the bank. This helps reduce your down payment. So if the bank will finance 80% of the purchase price, the seller can actually carry a mortgage behind the bank for 10%. That way, you're only putting down 10% to buy the property. They're in less of a secure position because there's a first mortgage on the property, but the benefit to them is they got the majority of their money and they're only carrying a small portion of their gain as a mortgage. This is a benefit to the buyer because it reduces the amount of down payment needed, really increases your returns, and gives you that extra buffer of cash so you can go out and do the improvements. Number three, preferred equity back into the partnership. So this is a unique strategy where the seller will actually reinvest back into your new partnership that's buying the property. They would be a preferred unit holder in the partnership, and they would get paid like somewhat of a mortgage where they get a preferred payment, say 8%. This would come out of all the first profits. And then secondly, they would be a small equity owner as well, where they would get a piece of the upside or the appreciation once you refinanced or sold the property. This could be advantageous to them because one, they get tax benefits by reinvesting in the new partnership. And then two, you run the partnership. They don't have to manage the asset. You're going to make the improvements. So they get to benefit from all your work improving the property. They get a kicker in there where they can actually get more of a return because they're now a partner or part owner in the deal. This takes a little expertise to explain this to a seller, but it is a really powerful technique because sometimes they don't want to invest the capital to actually finish the improvements at their property. They don't want to put in $500,000 to pave the roads or build an entire new building. And they want to reduce their risk, but they want to see the vision of the property completed. They want to see some young blood coming in there, putting the money in the asset. A lot of times these older owners, they built these assets from the ground up with their bare hands, and they want to see someone fulfill their vision. So it's really exciting for a young person to come in, have the experience and the capital, and then allow them to participate in finishing that vision that they originally had. Number four, a master lease agreement with the option to buy. So this strategy allows you as the buyer to actually lease the property before you close. Let me explain. So what we would do is sign a master lease, meaning that we're responsible or the buyer's responsible for all maintenance, taxes, insurance, all of the expenses, and then we're going to sublease to all the other tenants. So anyone that's actually at the property, we would be collecting rent, paying the expenses, and then paying the owner that master lease fee. Plus, you get an option to buy the property in addition to the lease agreement. So now you can go in and make the improvements to the asset, raise the rents. This therefore will increase the value, and you can exercise that option to actually buy the property at the agreed upon price. This is when you'll come in and get a bank to refinance the property, paying off the owner for that option price, and now you would get title to the property and be the legal owner. The risk here is you are not the owner, you are actually just leasing the property and making payments to the owner until you exercise that option. So you have to keep that in mind that if the seller is in bankruptcy or if there's litigation with the seller, it could tie up the property's chain of title where you can't actually put it in your name. You wouldn't get the deed until he cleaned the chain of title, and therefore tying up all your money and all the improvements you made to the asset. So you got to be careful in structuring this type of deal. But if there's very little money you have to put up front as a deposit and you have a good operational advantage, you can come in there, make the improvements, increase the value, and then buy the property at that agreed upon price. And you have very little skin in the game when you do this transaction. So, like me, if you don't have any credit or experience, it's a good idea to find a partner who can qualify for a conventional mortgage. That way you can actually go get a loan and buy these properties. But you can also structure these creative financing options and not need that partner that has good credit. I have to give a disclaimer. Banks tend to not like these unconventional mortgages behind their mortgages. They look at it like it's more risk to their loan, and that's something that they would not approve. So many times you'll need to get the bank's permission to allow financing behind their senior debt. They're the first mortgage, and then the seller would be the second mortgage, but that would trigger the loan covenants, and you would be in default, and they could call the loan due. Now, there's creative ways to structure this around the bank, and we can get into that more later in some of the future books. So here's the back of a napkin analysis that I like to use when I'm trying to do a potential deal. I look at it like the rule of thirds. I analyze the deal and see the monthly income, let's just say it's $30,000. Now you want the expenses to be no more than a third. The monthly expenses would be $10,000. Then you want to look at the monthly debt. The monthly debt should be no more than a third, $10,000. That leaves 1/3 left over for monthly cash flow, $10,000. This gives you the ability to pay half of that to your preferred partners, $5,000 a month, and then the other half to you as the sponsor, $5,000 a month. So this is an easy way to look at a deal. With mobile home parks and self-storage facilities, you can hit those numbers. Rules of thirds. Gross income is the total, a third in expenses, a third in debt, and then a third in cash flow. This will allow you to hit your projected numbers to actually be successful in a deal and to get that cash flow. Starting from the bottom. So, if you're starting out like me and you have very little cash, that's okay. That's the great beauty of this business, and you don't actually need a lot of money. Basically, the essentials are what anyone needs starting a business: a desk, a phone, a computer, some property lists, an education, and then this crazy idea that you can go out there and really do it. When I started out, my false belief was, if I don't have any money, then I don't have any value in this industry. And I had to overcome that limiting mindset. I remember walking around the conventions or going around trade shows, and it'd be these sophisticated investors in fancy suits, or these brokers that would have this superior air. They were better than everyone. And then I felt, where do I fit in here? I don't have any money, and I'm not even a broker. I'm an investor. At that stage, I had to figure out, okay, how am I different? And then I had to actually just overcome that limiting belief, like, fuck it, I don't need all this money. I don't need to look fancy. I just need to know what I'm really doing, and I need to go out there and solve people's problems, sellers' problems, and not go through all these middlemen. So in the beginning, don't be intimidated. The brokers don't want you in the industry. The professionals really don't care or don't want you in the industry. And reason being is they don't want to waste time with people that don't know what they're doing. But if you put the time into this and you know what you're doing, you build experience, you have good partners, then you get respect because people actually see you know what you're doing and they want to work with you, and they don't care what type of suit or watch or car you drive. Now, don't get me wrong. I mean, you do have to show a level of success and professionalism, and sometimes these material things show that you have that, but ultimately, no one cares. They want to know you know what you're doing and you are great at your craft. And when you start finding deals and owning assets and bringing deals to the table, people all of a sudden pay very close attention to you because they know, wow, that guy's got something special. Now, having money in the beginning is very helpful. Now, being broke is not the ideal way to start. Money will amplify the results you create, and then it will amplify your skills. But if you can figure out how to be successful without money, you're going to be way ahead of all the other investors, because once you do have capital from partners or from credit from banks, it's easy. The business is simple. This is the hardest part, is trying to be creative with nothing. Investor summary offerings. Okay, so how do you actually get the money from partners when you've never raised money before? Well, what you want to do is provide an investor offering or a term sheet or a summary of the deal. Don't make it too fancy. It doesn't need to have a million different pages with filler. Just 5 key sections, maybe 1 or 2 pages each. Number 1, investor return highlights and analysis. What's in it for them? That's all they want to know. What am I going to receive as an investor? How much money do I have to invest? And then what timeline is this going to take? Number 2, property summary and asset highlights. So what is it that we're investing in? Why is it special? What are the improvements going to be? Number 3, area market highlights and analysis. This is pretty self-evident. What's going on in the area? What are the market rents? Why is this a good location? Number 4, asset class highlights. So you want to give them a quick overview of why self-storage and mobile home parks are such good assets to invest in. And number 5, team and operational highlights. This is where you're going to want to highlight your track record and then outline the different players on the team. They want to make sure you're not the only guy doing all the work, because if something happens to you, then their investment goes out the window. So the paperwork sounds daunting, but it's really not. An attorney can help you set up your entity, set up your partnership agreement. It's also called an operating agreement. And they can help you finish up the purchase and sales agreement. Now, there are 2 different types of attorneys. One is an actual transaction attorney that helps specifically with purchase agreements and transactions in real estate. And secondly, there are attorneys that focus on partnerships and ownership organization. So sometimes you can get it all done under one attorney, but then other times you might want to find separate attorneys. They'll be able to do all this paperwork for you in the beginning. It's not easy to find a good attorney, so feel free to go on patriotholdings.com/resources. I'll give you a list of my recommendations. I've been through the ringer and spent lots of money on attorney bills, so take a look here. These guys are pretty good and they're very fair. Leveraging your precious capital. In real estate investing, leverage refers to using borrowed money to increase your profits. It's really critical. Debt is the critical piece to being able to generate high returns with real estate. However, you can expand the definition to mean utilizing any kind of resource you get that's going to get you going there faster. Leverage can be knowledge from other people. Leverage can be your own knowledge, skills, and experience. And leverage can be regulations or laws that produce an upside. So as I started to understand these things, I started to think more globally about how the power of leverage could be used with creativity to get deals done. And the 3 areas of leverage in business or real estate is, number 1, your capital, number 2, the tax benefits of real estate, and then number 3, obviously your time and energy. The bottom line is, how do you get a deal done with the least amount of capital as possible when you're trying to grow your wealth starting from nothing? Quick case study. Breaking down the New York deal. All right, this was my very first deal that I purchased by myself. It was in the middle of nowhere, New York, Watertown, New York. And it changed my life because it gave me enough money that I could actually live and not have to go get a real job and get a paycheck. So I invested $15,000 into that deal. And the way I saw it, breaking it down, I could invest $15,000 in the stock market. That was everything I had to my name then. And maybe get a 10 to 20% return year over year if I really studied and understood how stocks worked and I picked the right ones and it all worked out. So that would yield me a $3,000 profit, and then I would pay a third of that in taxes, and then I would maybe take home $2,000, and that's assuming that I picked the right stocks and made a good return. So there's no leverage. There's no chance for me to leverage anything in that scenario. As I invest that money, I buy that commensurate amount of stock, and then I get a return on the money invested. So the other scenario is I could learn real estate, go out and find a good deal, and get a 10 to 20% year-over-year return. So in this case, I bought the mobile home park for $615,000. I was able to get the owner to finance $600,000 of that, so I put $15,000 down. Now, the mobile home park appreciated $100,000 a year minimum, and it generated a minimum of $3,000 per month in cash flow. I didn't have to pay any taxes on that income because of the cost segregation study and bonus depreciation, which allowed me to write off depreciation, meaning it offset all those cash flow yearly distributions, and then I deferred paying taxes way down the road when I sold the asset. So the result was $35,000 to $60,000 a year in positive cash flow, and I made $400,000 in appreciation when I sold it across the 7-year life of the investment. Now, I would have actually made $600,000, $200,000 more than I made on that sale, but last minute, a buyer out of New Hampshire, I'll leave him anonymous, retraded me because he knew that I really needed that sale in order to complete the sale that I was going to do in Nevada. I found a great opportunity that was value add. It was a 48-unit apartment complex and a mobile home park, and I could only do that deal myself if I had that cash from this sale. So I had to learn to lose the small battle in order to win the larger war. Now, I got a little fired up about it, a little emotional, but in the end, I learned a few important lessons. Number one, don't have all your eggs in one basket with one buyer. So it'd be nice to have a backup offer, and I did have backup offers, so I should have took one because more options means more flexibility. And that leads into my second lesson. Number two, don't just have one funding source. So I was fully committed to this deal that I was buying. I already went hard on the earnest money deposit, and I was counting on this money from the sale. Now, I should have had other options lined up, either some hard money or a capital investor to bridge me a loan. But that's not easy to create. I didn't have those relationships at the time, and they weren't available to me. But if I wasn't desperate with that one sale, he could have never leveraged me, and I would have never dropped the price. But in the end, the next deal was really great, and I still won the larger war, took the losses in the battle, moved on. How to obtain capital. So with real estate, there's a couple ways to get capital. Number one is through debt or financing. And number two is capital raising, equity. Got to go out there, create partnerships, and raise the money from individuals or institutions. So a way to help raise that money are the tax benefits of real estate. So first, I leverage the tax benefits. So if you qualify for a real estate professional status, commercial real estate investing has some great tax benefits. So if you're an active investor, you qualify this in the IRS's eyes automatically. The tax deferment maximizes your investment potential because it frees up more of your income. You can use your gains in real estate to invest in another project, leveling up your next deal instead of you paying 20% plus in taxes. We'll get into this a lot more in future books, and this is a key strategy to scaling and multiplying your wealth in real estate. A primary way to leverage your capital is to take on debt, also known as other people's money. Your options are banks, individuals you may partner with, including friends and family, even the seller. Some banks specialize in loans for commercial property. These are typically credit unions or their local community banks, and it's important to find one that will be a part of your team because they're going to be very important with these value-add, smaller commercial transactions. And what I mean by smaller are typically $1 to $10 million loan amounts. Now, obtaining financing from commercial banks is a relationship game too, and you should know the different types of financing you can qualify for right out of the gate. So I would go sit down with your local or community bank and build that relationship and show them that you have some credibility. And if you don't, go in there and at least open up a CD and then borrow against it. I learned this in my first commercial real estate no money down course. Just to build some credibility with the bank, you can go in there, get a $5,000 certificate of deposit. Now you have an asset at the bank, and then you can pull out a personal credit line or some type of loan. It's a secured loan. That's the key. The loan is secured to the CD, and now you make payments on that loan, and then you build a credit history with the bank. So it checks off this box that you're an existing customer, that you have a loan with them, that you made timely payments and you paid the loan off. And then eventually, you don't have to have a secure loan. They would probably lend you money regardless, especially if you have a good asset. Now, one of the key questions to ask the lender is, do you lend on self-storage or mobile home parks? You want to make sure they like the assets that you're trying to buy. And if they do, make sure the terms are competitive with market rates. Meaning, do they lend 60, 70, 80% loan to value? Do they lend at a fair interest rate? We'll get more into loans later, but you want to build the relationship with the bank up front rather than waiting to the last minute when you already have a property tied up and then you're scurrying trying to find the financing. One of my most valuable team members is a loan broker who gets me the commercial loans, and they go out there and they shop the community banks, shop the local banks, and shop the institutional banks and make sure we get the best loan for the project that we have. It's well worth it. You pay them a 1% fee of whatever the loan amount is, and they communicate with the bank. You might have to do one interview, but they're going to submit the entire package on your financials and on the financials and the story of the property. It's well worth it. Let them represent you. Now, you personally need to build a relationship with the bank, but let them present the information professionally and get you the most competitive pricing. So regardless if you're getting a conventional loan with a traditional bank or you're getting seller financing where the owner's carrying a mortgage for you, the cash-on-cash returns on your investment generally correlate with the leverage. The risk involved actually correlates with the leverage as well. So the higher the leverage, the higher risk, and then the higher potential return on the investment or cash-on-cash return. And also the inverse applies. So the lower the leverage, meaning the loan amount, the lower the risk, the lower the return on investment or your cash-on-cash return. Now, you'll learn circumstances where paying all cash for a property will work to your advantage. Mainly because you can close quickly and there's no one else involved. You get to choose to close on your timeline and be able to capitalize on situations where a seller needs to close quickly. This liquidity will allow you to capitalize in recessions. This is huge in real estate. When banks tighten and they heighten their lending restrictions, there's no capital out there in the system and property values decrease dramatically. So having access to that cash gives you opportunity to capitalize on these deals during these down markets that you would otherwise never see. And regardless if you close cash or with conventional financing or seller financing, if you're going to hold the property, the goal is to come back and refinance when there are good debt markets. And you're going to be looking for good low leverage loans, low interest rate loans, fixed rate loans that are long term, 10 years or more. This will allow you to de-risk yourself off that property, and now you either pulled out your cash from that loan or you at least paid off your existing loan and you have some certainty around the debt. Ideally, if you personally guaranteed the loan when you bought the property, when you refinance, you want to get off the debt, meaning you want to get non-recourse debt versus full recourse debt. This is icing on the cake. Now you don't have to guarantee the loan, and if all hell breaks loose and you lose the property, you're not obligated to pay that loan back. Your personal credit is no longer tied to that loan. Seller financing. So I'm going to dig into the details and the benefits of seller financing, and this is one of my favorite aspects of the commercial real estate business. It's the primary way to do a no money down deal, and everything's really negotiable here. There's no one set way of what the loan amount should be or what the interest rate should be. It's really up to you and the seller. Now, seller financing involves two people, obviously a buyer and a seller, and you really don't need a broker, you don't need banks, you don't need appraisals. That's what I love about it. Now, what the seller truly wants, especially if they're selling to retire or if they're selling to finally not have to manage the property, typically they want the cash flow, and the seller financing gives that to them. Now, some sellers understand how this works, and then others don't understand how it works. So you're going to need to educate them and show them that they have nothing to lose and everything to gain. This option would replace a chunk of the money from the sale that the owner would have to pay capital gains taxes on, and then with monthly payments over time that include interest on a note that they're carrying for you. So this is a big tax savings for the seller. Seller financing is the best way to get a no money down deal for the buyer, hands down. Here's a short list of the benefits of seller financing. You don't need good credit. You don't need a lot of capital for the down payment. There are few, if not any, fees for the loan. There's no long, drawn-out credit approval process. There's no appraisal needed. And if somehow you as the buyer default, the seller gets the property back and gets to keep your down payment. So the seller gets to use their equity that they've created over time, and they can generate interest income from it without paying capital gains taxes. Many people might say there's not a lot of sellers who want to carry a mortgage, but I definitely disagree. Many of the sellers I've worked with or I've talked with, they only want to carry a mortgage because they don't want the severe tax hit on the capital gains from the sale. Setting up your deal with seller financing requires building a relationship with that person first. Many owners are not big investors, they're just mom and pop owners who had an opportunity to get this asset built, and they've owned it and managed it for years. Now you got to remember what's important to the seller, and it's not nice clothes or fancy cars. They're going to want to know you're a down-to-earth type of guy that's going to do what he says he's going to do, and that you're going to make those payments every month. Keep your cash for your deals. So, in this industry, I said it before, there's a lot of egos, and many people think they need to show off their wealth in order to build credibility. This is not true. You do not need to look flashy, especially if you're working with mobile home park and self-storage owners. Look professional, don't be pompous. People want to deal with confident, normal people that are relatable. Of course, have a nice website, keep the marketing simple and creative. Direct the marketing to convey that you're a credible investor and that you're a person of integrity. Often, larger, flashy companies don't get the opportunity to buy from mom and pops because it's too intimidating. The loudest, flashiest person in the room is normally the weakest person in the room. I know you've all heard this or seen this or felt this. They're trying too hard to show off how great they are or how much cash they have, and these people aren't typically that wealthy. Let your unique knowledge, creativity, and integrity do the talking for you. Be yourself. It's worked for me. I learned it from my father. Anytime you act fake or act like something you're not, everyone can smell it on you like a cheap cologne, and it's disgusting and repelling. Be who you are and be authentic. That's just the best way to do business. So how much cash do you need to get started? You'll need some cash for closing costs and the entire process. Even if you negotiate a deal requiring none of your own capital in the down payment. This is another reason not to spend all your cash on flashy cars and nice clothes. You need your reserves for deals. Your investors will not cover these expenses. To secure a deal, even a no money down deal, here's what you'll need for cash. Number one, you need an earnest money deposit. Anywhere between $10,000 to more than $100,000. This could be 1% of the purchase price or up to 10% of the purchase price. This earnest money deposit is used to secure the deal. Number two, due diligence reports. You have to go out there and get third-party inspections, and these could cost $20,000 to $40,000 during the due diligence process. They will need to be paid for. Sometimes you can pay for them at the closing, but some require upfront payment. Number three, you need the cash to pay for the attorneys to draft up the agreements. This can get out of hand sometimes, and the attorney fees are quite expensive. Number four, engineered drawings if you're making any large expansions or any submissions for building improvements. Number five, you need to pay your staff to help you stay organized, so you have to have cash to keep the deal moving and have the right people in place to get it done. Number 6, you're going to need some money for your CPA in order to get cost segregation studies or tax advice. The worst thing you can do is build a millionaire lifestyle because you start making some money. If your ego inflates too fast, you'll find yourself making poor decisions because you need to cover the cost of this fake, luxurious lifestyle. It helps to show big bank balances when it comes to obtaining financing. It's important to highlight you're managing your cash and your reserves effectively, especially when banks are looking at you. There's a fine line between how much money of your own you're going to need to invest versus how much money you need to raise on the deal. Investors like you to have skin in the game and like you to invest your own cash in each deal. Plus, you're always going to need to have cash on hand for great deals as they come. You never know when the real estate gods are going to give you a great one. Plus, you never know when the market goes dry and then you have no deals for quite some time. I mean, it sounds like common sense, but you never want to run out of money. It's entirely possible you can get caught in a rough cycle, and I've done it, I've had it happen to me before, and then the cash bleeds quickly. This is real-life monopoly, and $10 million in real estate is peanuts. So protect your precious cash, because in any down market, it's the most important asset you're going to have. Ways to create liquidity. Well, the first way is to go out and build a business and make a lot of money and then go invest in real estate. But if that's not what you're doing right now and you're trying to build cash in real estate, you can do it in these 4 ways. Number 1, generate cash by assigning deals to other buyers and working with partners so you can earn a fee. This is what I did. I went out there, found deals, signed them up in contract, and then assigned them to someone else that actually bought the property, and I would get a fee at the closing. Number 2, refinance properties you own, which can be done roughly 12 to 24 months after you've stabilized it. This is the best technique in real estate because you don't pay taxes on the refinance. You're able to pull cash out of that property, still own it, still get the cash flow, but then get some liquidity. Number 3, sell the property and use the proceeds to buy a bigger and better asset. Number 4, hold the property and just keep taking those distributions, cash flow year after year through rent increases and efficient operations. Think differently. So mobile home parks and self-storage facilities can be grimy-looking assets. Yes, there are some nice ones in Florida or in California, or there's these really Class A facilities in urban markets like New York or Boston. But the ones that we buy typically don't look that sexy. They're not flashy like high-end retail or office properties, but they cash flow tremendously. Who cares what you look like when you're winning the game of financial independence and freedom? Keep thinking outside the box. You must always find new ways to differentiate yourself from the competition. You can't be a sucker standing in line waiting for a deal to fall in your lap. For me, I've had the best luck building a database of mobile home park and self-storage owners. It was boring. It was tenuous. It was something I hated doing, but it was my edge. You must be creatively resourceful, especially in the beginning of your career. Necessity is the mother of invention. Sometimes in the beginning, you'll have to find rougher assets, ones that are harder to manage in rougher areas of the country. It's more likely that the owners and sellers will finance these or allow for creative financing and structures like a master lease. The challenge in managing these assets is the opportunity for you to take over and add tremendous value. Be careful, though. You still need to invest in markets that have positive fundamentals. I mean, obviously, decent jobs, decent industries, hospitals, schools, and so on. And never forget, though, that economic downturns are always on the horizon. They will shift the whole lending world. So creative financing and creative partnerships will allow you to do deals when the market starts to freeze up. And knowing these techniques give you the options to get deals done when no one else is able to in the market. How do I get some extra cash to close? So here are some examples of being creatively resourceful to fill your capital stack for a deal. So number 1, trade some equity points or some ownership in your deal and have your loan broker reinvest their fees back into the partnership. So have your loan broker invest their fee they make and put it back into the partnership. Number 2, Ask your attorney to reinvest their fees back into the partnership as well. Number 3, trade your time and energy for an ownership share. So in the beginning, when I didn't have any money, I earned sweat equity, which means I found the deal, I project managed parts of the deal, and I earned up to 20% of equity in the deal. Number 4, sell off a part of the asset such as a cell tower or a single-family home, or subdivide a parcel of land that's not needed. I love this technique where you can carve off other pieces of value on the asset and sell it to someone else, recouping some of the capital you need in order to close. A seller leaseback. So you can pay a little more for the property, but get the seller to lease back a portion of the property for an extended period of time, paying you the rent in advance at the closing, and this puts some cash in your pocket. This only works when the seller wants to stay there and continue using the property, but they're going to give you a credit at closing for all that rent that they paid for in advance, and this helps you put some money in your pocket. And number 6, I'm going to beat a dead horse with this, but ask them if they would consider financing the first or second mortgage, and that will help reduce the amount of money you need at the closing. Getting creative with on-site management. So as I've shared, mobile home parks and self-storage facilities are very challenging to manage. I used to hire a third-party manager, meaning a management company, but I found after a bit of trial and error that the best on-site management is actually someone that lives on the property, and it would consist of a husband and wife team. Normally, the wife will collect the rents and the husband will do the repairs and maintenance, the lawn service, and if you're lucky, the snow plowing. Having the on-site management team helps handle the delinquency calls, knocking on doors. You know how that goes. Hey, you got to pay your rent. This is huge because it increases the collections. On-site managers provide critical solutions that are often overlooked when third-party managers are not on the property. Instruct the managers to work with the tenants in getting paid. They have to communicate. They have to have a relationship with your tenants. This gives the tenant an opportunity to create an agreement with the landlord to waive fees if they give enough notice and they create a payment schedule to pay back their late rent. Everyone's not going to pay on time. In this industry, you have to be flexible with people. Going out of your way to establish and maintain communication with your tenants will give you a very competitive edge as a landlord. We like to have a Facebook page and a monthly newsletter and stay involved with the mobile home community. Also, you want to give people the most opportunities possible to pay their rent. Pay online, you can pay by checks, you can pay by credit card, whatever it takes, just get the money. And then start with kindness at the top, in the office. Give your office employees kindness and perks. Show your on-site managers you care, obviously by making the improvements. And this trickles down to the rest of the community. Create a culture of giving. We like to do good things for our residents, like giving turkeys during Thanksgiving or Christmas, or Walmart gift cards, because it shows how much we value them and we know that they could use the help. Creativity and private equity fund management. So something we do here at Patriot Holdings that makes a little bit of a difference and keeps investors happy. In some of our syndications and funds, we pay our distributions monthly and sometimes quarterly, but mostly monthly. So people who invest in real estate, for that matter, they love the monthly checks, so we give it to them. I love it on my investments. Who doesn't love money every single month from their investments? It's a matter of getting the right bookkeeping in place and the right accounting team, and it's not easy to execute on. But it differentiates us, and the investors love it, and they tell their friends about it. On-market versus off-market deals. I've pretty much hammered the fact that you want to look for off-market deals in order to get good opportunities. Yet there are good deals listed, and you can find them online, either LoopNet or CoStar or any of the MLS brokerage sites. But the strategy of making a lot of offers is critical. You have to put out a lot of offers in order to get these listed on-market deals under contract. The best on-market deals are the poorly marketed ones by local brokers. They don't expose the properties to national buyers. So if you hear the owner say, I have the property listed, all hope is not lost. They might be with a local broker who doesn't even deal with self-storage or mobile home parks, and they won't market it effectively, and you can still have a good opportunity without a lot of competition. Brokers can be your best friends. As of recording this audiobook, the market is down in 2023, and now the strong survive. Knowing the key brokers in your asset classes and your region and having a close relationship with them so they know you have the credibility, the cash, the ability to close on these assets, this is going to create tons of opportunity because they're going to come to you first. They know you're professional, and they're going to give you opportunities because they want to get paid and they want to make the commission. So for me, I'm investing a lot of time in building these good relationships with the professional and solid brokers around the country that deal specifically with self-storage and mobile home parks. Chapter takeaways. Creativity will always differentiate you from other investors that are out there. Very few investors put the time and energy into the small details that can maximize the potential of each deal. They truly don't understand the aspects of management, of capital improvements, of financing, of capital raising, and that will give you an edge once you master these areas. Find your own creative solutions to adding value in the deal and the partnerships. Don't buy into industry dogma that things need to be done one certain way. There's so many different ways to do a deal in real estate or create a partnership. Don't buy into the industry dogma that these things can't be done. Seller carry or owner financing was the cornerstone of my strategy in the beginning. I had no money, and this is still a true win-win method of financing properties. In commercial real estate, this is normal, so don't let any broker or anyone tell you that's not possible. Creativity starts with building the right culture in your company, and it needs to translate into every manager or employee you have. It won't happen overnight, but if you work at it and you lead with it, it will translate down to your entire organization. I love resourcefulness and relentlessness. If they see you lead this way, it does sink in and it becomes a part of their work ethic and in their blood. This is the ethos at Patriot Holdings. You individually have to have an edge that you absolutely believe in and you know how to maximize. My first edge was creating relationships from scratch, finding off-market deals, and making opportunities to negotiate seller financing with individuals. Your creative edge may be structuring good partnerships and raising capital, or understanding the construction process, or being excellent at managing these assets, or even securing superior debt. There's many ways to be creative in each of these areas of real estate. I just listed what I was good at by building these relationships and finding the deals. So dig into your strengths, figure out what you know the best, and then find that creativity in that individual area that you want to focus on in real estate. And that will create that enduring advantage that will last for decades. Edge Principle 3. Stay the course to win. Invent yourself and then reinvent yourself and stay out of the clutches of mediocrity. Charles Bukowski from The Pleasures of the Damned. First, let's put success in the commercial real estate business or even in the game of investing in perspective. I love this business, yet like any skill you learn and then master, it takes extreme repetition. It takes doing the same actions over and over and obsessively thinking about the same things. You talk about these ideas and you write them down on yellow pads again and again, and then finally things start to come together. But when they're happening, you don't really associate all those repetitive steps as the reason for your success. The 10,000 hours rule mentioned by Malcolm Gladwell in his book Outliers truly is based on the fact. Significant results took years longer than I expected. It must be attributed to youth because during the first 10 years of my career, I thought big things would start falling into my lap after the first couple of small breakthroughs and successes. Now that I'm in my 40s, I begin to realize how much work it really takes to achieve goals and obtain any significant results. Maybe that's why I naturally gravitated to sports and bodybuilding because I was used to the same repetitive action over and over to get good at something. It always stands out in my mind when Arnold Schwarzenegger talks about how he became the most successful bodybuilder in the world is reps. I mean, he ingrained in himself, you have to put in the time and be repetitive over and over. It's almost mind-numbing, but that's what it truly takes to be the best. You know where reps are involved? I'm doing the final edits on this recording in the studio, and my extremely detailed audio engineer keeps telling me to do it over again, repeat these small sections and mistakes, and then get it perfect. So I know doing this book, this is about reps. In the pursuit of any goal, it's easy to make things out to be a lot more complicated than they need to be. Remember, simplicity is the key to effective execution. Complexity kills execution. It can be overwhelming thinking of all the daily tasks it takes to not only get a successful deal done, but also to build a durable and dependable organization. You need to get your mindset right, and you need to be able to see the big picture through the bird's eye view of timing, gratitude, and attitude. The inner game versus the outer game. Real estate investing at its core is truly an inner game. The real battle in real estate investing and running a business isn't the other investors competing against you to buy property, it's purely against you. How do you handle the thoughts, the doubts, the fears, the worries that are going inside of you day in, day out? This is the inner game. Inner game consists of a healthy body, emotions, and mindset. For me, my mind can be a fucking monster, bordering on obsessive-compulsive, so I need every advantage available to me. Overall, physical and emotional health and wellness are where this starts. Taking care of my body and health habits. Keeping great people in my life. Staying motivated and driven by feeding my mind with interesting things like history, psychology, science, philosophy, and inspiring stories in books and movies. I can't just solely be focused on business. I have to stay stimulated in all different areas of my life. The next principle, never get too high, never get too low, it expands on how to maintain physical and emotional health. And that principle is the foundation for principle 3, staying the course to win, and you have to win that battle daily. So what drives you? What inspires you? Business is a mental sport, but in order to endure the decades of play, I believe you need to have a fire and passion for some aspect of it. A journal is a great way to take stock and clarify your thoughts. I've been doing it since I was 13 or 14 years old, and it's been really important to me to help get what's inside on the outside and help articulate how I feel, the problems that I'm going through, the challenges, and just to really express myself when I felt like I couldn't share some of these things with other people. A mentor of mine now calls it thinking time. So start by simply writing down what's on your mind. Write down some of the questions that you have, some of the problems that you're facing, the good things that have happened to you in the past or in the moment, and the deadlines and the results that you're working towards. Journaling and then revisiting what you wrote later helps you build perspective, and it lets you start seeing patterns in your behavior, in the thoughts and the feelings, in the actions and the energy that you bring to things. It's crazy. I can look back to some of the things that I wrote 20 years ago, and I was baffled by how I thought, and I see how much I've grown as a person, as a business person. But honestly, I see also that I have this intrinsic nature of who I am, and I'm glad that was there. Like, that has always been in me, and there's that purity that was a part of me before this world has worn me down or affected me. So I can see the difference in how things have shifted, and I see the good side and I see the bad side, and I can see where I've came as an individual, and I'm proud of that. But I wouldn't know if I didn't have a journal. I would have missed out on so many beautiful memories or experiences or transformations that have occurred. Outer game, straight formulas. The outer game constitutes the actions that you take to achieve your goal. Part of the outer game is based on your mindset too, but results in the actions that you choose. The probability gets higher for your success as you do the work. Stay the course is about the inner and the outer games. I mean, you have to take action. That is just simple. The outer game is where everything happens. All the inner work in the world won't help you realize your goals if you don't take the action. Focus on building the database and broker relationships over time. Sellers and brokers will start to remember you. Persistence wears down resistance. If you don't ask or make an offer, you'll never get a deal. So embrace those tough conversations. I heard once that the success in your life is directly correlated to the number of difficult conversations you're willing to have on a daily basis. So embrace those. It's good to be uncomfortable. The following straight formulas are the foundation for the work in the outer game that you need to do every day to achieve your goals. The repetition is just part of the process. Understand the cause and effect. You do this, and then you get that. Learn your specific niche in your field. What are you great at? And then learn it and master it. Do it over and over and over. Adapt and adjust to see what's working and what isn't working. These are the fundamentals. It's not rocket science. They pay off over time. Don't get me wrong. You can have the best attitude in the world and the clearest vision, but you got to do the work. This is simple stuff, but this is the true science of achievement. So how do you keep doing the same repetitive actions year after year? I believe it lies in daily efforts to build your mindset. This creates momentum in both directions. Negative thoughts and actions breed more unwanted problems in your life, and positive thoughts, healthy habits, and good people build the momentum so even on the days when you feel like garbage, you continue to make that progress. One of the keys to maintaining momentum is not to get stuck focusing on every minor thing. It's the big picture that really counts. Trust me, you have to focus on the little details, but when it comes to attitude or your energy or demeanor, you got to see the big picture, and that keeps you invested. It keeps you excited. It keeps the momentum. And that's what I do when I really step back and start to realize, okay, it's not so bad. You're going to make it. This is the big picture, and this is what really counts. How do you keep doing the same things over and over? Honestly, sometimes what keeps me motivated is a little mysterious, and I'm sure it is for everybody. How does a painter paint every day? A musician practice every day? A writer write every day? I don't know. You're striving for something as you learn more. You focus on areas you need to improve, and that keeps driving you. Those are the true masters of their craft. Every little improvement excites them. It comes down to winning that inner war. If you don't win the inner war, the inner game, you're never going to see any activity in the outer game. No one articulates this better than Steven Pressfield in The War of Art, where he describes overcoming resistance in his book. For most of us, the resistance appears in that window right when we get up in the morning. We have our breakfast or our coffee, and we decide to do what we know we're supposed to do. And if you're like me, you'll find any way possible to get out of that task by making up the most absurd distractions and excuses. And then it comes down to this. It's, can you practice your craft for 3 to 5 hours of uninterrupted, dedicated, focused time or not? It's your choice. You either do it or you don't. That's it. You're not a victim. No one is taking advantage of you. You have this power and you choose to do the work focused, not distracted. If you do it consistently, or if you consistently don't, your actions in either direction will gain momentum. Distractions and bullshit and time wasters over time will create negative thoughts and actions that breed more unwanted problems in your life because you have negative behavior. Yet the daily discipline, the focus, and pride in your work, they create positive thoughts and healthy habits. And in the other direction, daily discipline, focus, and pride in your work create positive thoughts and healthy habits. And this attracts you to good people who are going to help you build momentum. It will get easier. Some days it seems like you made no progress, but the fact you put in the work and you did it consistently in that time frame, in that habit, that causes you to automatically want to do it again and again. So the short-term win is doing the habit. This momentum will push you through even on days when you don't feel motivated, and you won't. Trust me, everyone that's successful does not feel motivated, but you will continue to make the progress no matter how minuscule it is. Daily compounded progress is the fucking secret to success. There is no magic pill. That is the secret. Don't misunderstand me on this. I by no means have it all figured out. I'm not the poster child. It took me 2 years to write the somewhat poorly written first draft that ended up becoming this book because I didn't keep that momentum. But I do believe, no matter how silly it sounds, that my craft was and continues to be communicating with others. Where I did practice repetition is in me prospecting to sellers to buy property, then working with and attracting investors, and then leading my employees. My craft is strategizing and communicating on how to build my business. To that end, I get on the phones every day. I'm meeting with my staff every day. I create capital structures and I look at acquisitions, and then I communicate the plan with confidence and clarity. I do this to my partners. I do this to sellers, brokers, investors, and my own team. This is what I work on over and over, refining and learning from my mistakes and from the other people that I see in the business who are already great at the craft we call investing. My main focus as the leader is to make sure I keep track of the critical drivers or the priorities, and then I dictate these priorities of the business. I work hard at not allowing myself to be distracted during that prime focus time every day where minor things or insignificant emails or phone calls are going to try to distract me. Again, by no means am I perfect at this, yet I understand how important it is. It's the big picture that counts, and I have to stay focused. I have to keep driving deals, raising capital, and empowering the team with clear objectives. All that other bullshit can get in the way, and it kills my goals. Attitude, accepting discomfort. Oh man, okay, this one I'm passionate about. So I believe our culture is built around avoiding pain and avoiding suffering. We encourage to always do or choose the pleasure. But what's the truth? The pain is where the real growth is. The suffering and the discomfort are where the change occurs and the real lessons are learned. Even now with the success I've achieved, I put a high value on working to improve and push myself every day to feel extremely uncomfortable in some area of my life. Who gives a fuck about what you did in the past? Who are you today? Who are you being? Who are you becoming? I focus on exercise. How's my physical body? How am I improving? My communication with speaking and writing. My connection and communication to the loved ones, the friends, or my team members on conveying a message. This is how I learn to get the best from myself. I'm striving to maximize my full potential, and I know I won't get there without discomfort. This is how I learn to get the best out of myself. I'm striving to maximize my full potential, and I know I won't get there unless there's a lot of discomfort. When I was young, I used to run away from my problems. I ran away from girlfriends. I ran away from people I owed money to. I ran away from just confrontation in general. It wasn't until I reached a true low point in my life that I had a complete shift. Now, I fucking face everything head on. If you need to make a change, you need to get fed up and act. Fuel your fire. Fuel your anger towards making that change. Your mind will play tricks on you, and I've learned that fuck that attitude motivates me. Something like, fuck you, mind, I'm not going to handle it that way. No matter what, I'm not going to dip down and be that type of person. I'm going to stand up and I'm going to handle it. If you want to build your business from nothing like I did, you may be alone for a lot of the time. For me in the beginning, it was very lonely. I didn't think as a kid I'd spend at least 20 years in an office, but the reality is I have. Yet this business that I worked on alone for so long, it will allow me to choose and do and have anything I want for the rest of my life. You must put in the work to understand how to find and control good deals. If you want to be in real estate, that is the key. For me, I couldn't have learned what I know now any other way. I had to go through this trial of fire, this process. That's why I'm sharing my hard-earned lessons to you as you choose this path. That way you're fully ready to compete in this competitive world of business. Being grateful gives you perspective. So for me, to help stay the course in my journey, I had to be grateful. I always need reminders to this because I think it's human nature, or at least in my nature, I take things for granted. I don't want to sound preachy, but remember how lucky you are and the fact that you have your health, opportunities here in America, you have access to education, you have friends, you have family, your mind is sharp so you can solve your own problems. The reality is many people on this earth would die to be where we are and to have what we have available to us every day. In this country, you have everything you need to be successful, and you can find a way to make it work if you're committed. Small wins are super important. Building your database and making good contacts, these are wins because they help you build good relationships. Don't be disappointed if you aren't closing on deals every day or week or month. That is not a failure in this business. You stay the course, and if a deal falls apart, yeah, you lost a battle. Just remember the power of momentum, and good things will come. It might take 6 months or 12 months or 18 months, but repetition is the key. I just kept focusing on building my database over time, and then these sellers, they started to remember me, and they'll remember you. I also focused on building those broker relationships. When brokers know that I could deliver on what I said, they're more willing to work with me. Once I had some capital to invest, then brokers became a valuable team member for me in deal flow. The probability gets higher for your success as you do the work. There's no magic pill, right? That is the message on this chapter. It's an accumulation of advantages over time, and every day is an opportunity for you to get closer to that goal. If you don't take the action, you don't get the result. It's clear, it's simple, and you decide your future. Nobody else. That's it. I'm going to quit beating this dead horse. Building on small wins. The best time to plant a tree was 20 years ago. The second best time is right now. That's an ancient Chinese proverb. If you start early in life, time's on your side. Even if you're starting later in life, keep your perspective on what it takes to progress in this game. Small wins are important, especially in the beginning. It's important to understand what a small win is. Finding and understanding and taking the time to reframe how you look at winning in real estate is important. In the beginning, I thought it was all about how many deals I closed, how much money I made, how much success I looked like I was having. That didn't work. There were long periods of time when I didn't make any money or have any transactions in the works. Now I can see how focusing on the little details and hitting small daily goals are keys to a long-lasting, successful career. I was making progress, but at first I wasn't looking for evidence of it in the right places. Yet somehow I found a way to keep smiling and dialing, baby. I started to feel good about it, and even when no money was coming in, I felt like, oh yeah, I'm making good progress. People wanted to talk to me on the phone. They weren't just hanging up, and they were actually answering my questions. We were having a dialogue. I was building a friendly business relationship with them, and there was droughts in my career where I didn't see any financial rewards, but I knew intuitively from this communication with these people, that feedback that I was getting, that I was on the right track and that things would turn. Wins started to look different for me. A win was building that solid database where I could start to understand who owned what assets and what was a good and bad asset or what was a good and bad seller that I didn't really want to deal with or I wanted to deal with. So I was able to reframe what a win was to me, and it was making that good contact where people warmed up to me and they started to remember my name, ultimately building that strong, solid relationship. Evaluating a deal that I was excited about buying, but I found a key inconsistency in the due diligence or the underwriting that caused me to cancel, and it opened up my eyes and I learned something new. Like, even though I didn't close the deal, that was an important step forward, and I learned and I looked at that actually as a win. I started to realize I wasn't disappointed if I didn't close on deals all the time or made a lot of money. It wasn't failure at all. Learning and growing were the true wins that helped me stay my course, and even if I lost a series of these little battles, in my heart, I believed I will win the war. The Nebraska property, a game changer. I bought a property in Nebraska on my own early in my career, and it's a classic case study of staying the course. I'd called Donna from Kearney, Nebraska on more than one occasion, and I worked my list, and I finally got a hold of her in 2011 where she wanted to talk. She explained to me that her husband passed away, and she lived a great distance from her mobile home park in North Platte, Nebraska. She was thinking about selling, and she gave me some basic information that I needed to make an offer. In my evaluation of the deal, I looked at the size of property and reviewed the tax returns. The rent roll had almost 200 people living in 250 spaces, yet the income was only $250,000 per year. It was about $100,000 shy of what it should have been. In my mind, the only explanation was her manager was stealing from her. In my initial communications, Donna actually wasn't the problem, it was her lawyer. The asking price was way too high for the income it was showing, and her attorney wouldn't come down on the price. Her attorney didn't really like me much, and she wouldn't agree to the lower interest rate, nor would she return any of my phone calls. You'll find that the seller's attorneys and accountants can sometimes be the hardest hurdle to overcome, especially when they're obstinate in their conventional opinions. I'm sure she didn't see me as a high-quality, credible buyer since I had very little cash, bad credit, and I looked and sounded extremely young. Donna hadn't been to the property in a few years, and I was certain the manager was having a free-for-all with the rent. I had to go back and explain to her attorney that the property wouldn't cash flow at the $2 million asking price. Instead of asking Donna to reduce the price, it was clear the $2 million number was important to her. I had another idea. Then I realized once I could start collecting all that delinquent rent and get rid of the theft problem from the manager, I can go in and raise the rents and the property would be worth significantly more than the $2 million price I paid in a few more years. The critical piece was the cash flow. The monthly payment had to be low enough in the meantime so that the current net income could at least make the debt payments and the property could break even. As my longtime teacher Scott Shield told me, I'll pay your price if you give me my terms. And it worked. So she accepted my offer at the $2 million price, and I was able to negotiate terms where I put down 10% or $200,000 as a down payment. And then the remaining balance, the owner carried at $1.8 million as the loan amount, I think at a 6% interest rate. But what was key is that I was able to amortize the loan over 40 years, decreasing the payment where she wanted to get some of the principal and didn't want just interest, but I got that longer period of time to amortize the loan, keeping the monthly payment down. With just $100,000 in my own bank account, which I earned through referral fees from Dave Reynolds, I was short about $100,000 on the down payment for this deal. At that time, I didn't know anyone else who would give me $100,000 to invest since no one had any reason to trust me with their money and I had no track record. Luckily, a month before I got the deal under contract, I went to one of those real estate investors, Rich Dad, Poor Dad cruise seminars. Robert Kiyosaki and his crew were speaking, teaching about financial intelligence to investors all over the world, and I made some valuable connections at that event. On this investment cruise, I met a unique, funny, crazy 22-year-old guy from the UK who was making good income living in China. He sourced and sold cell phone cases to the large grocery chain Tesco back in his home country of England. We hit it off well, and he could see the value in mobile home parks, and he had the cash to invest, and he believed in what I was doing. So he put up the other $100,000 on a handshake. I didn't know if he was going to be reliable, but hey, I had to go for it. And actually, it all worked out, and he still invests with me to this day. He actually works in my company, and that's been another lasting relationship that continues to pay off. So during that time, I was pretty nervous. A lot was riding on that deal. This was my first big opportunity to buy a mobile home park, and Donna really wanted to sell. I built that rapport, but in addition to her attorney's attitude, her CPA kept telling me no, she needed to keep the park for more income. She finally had enough and decided, forget the advisor, she was going to sell to me, but she wanted me to come out there and meet with her face-to-face to earn the trust in order to finalize the contract. Getting there required me to fly into Denver in the middle of winter and then drive to the western part of Nebraska. So at the time, I was super tight on funds, and I reached out to an old high school buddy of mine in Denver. He ended up moving out there. His name was T.C. Eden, and he owned a medical testing business that would do heart studies on some of the Denver Broncos, and he owned this big white van with a heart machine in the back. TC said he'd love for me to crash at his house, and he was curious what I was working on. I remember how funny it sounded as I explained that I was buying a $2 million mobile home park, but I didn't have any money to rent a car or get a decent hotel. I needed every dime of that $100,000 for my down payment. At the moment, he didn't quite understand why I wanted a trailer park in the middle of Nebraska, but he recognized how passionate and how excited I was about it, and he told me, yeah, man, just take the van for a couple days for your meeting. So I drove out this oversized monster van that had this lift gate and this huge piece of medical equipment rolling around, banging in the back, and I went out there and I got to Donna's mobile home park. I'm forever grateful to my buddy TC, who sadly died way too young. Man, he had a huge heart, and everyone who knew him could feel how warm, how special, how caring his energy was. It's truly contagious, and even at the time, I really needed that, actually, in my life, someone to support me like he was doing. And it just made a big impact. When I really needed the help, he was there to help me and listen and support me. And I just want to thank you, buddy. All right, so I'm sitting at Donna's kitchen table, and we're both looking out the front window, and she's staring at this white medical van sitting in her driveway. And I could just imagine what she was thinking as she's looking in my eyes. She's like, what is this kid driving out there? Why is he driving that thing? So I quickly interrupted her train of thought. I gave her the best sales pitch I had to convince her to sell to me, explaining how the deal would solve all her property management issues and her estate tax problems. Not to mention, it would provide her with that monthly steady cash flow that she could retire on. My friends called me that night back from Vegas, and I was staying in this really old, run-down hotel in the middle of nowhere, Nebraska. I think it was actually 100 years old, and it was made of like mud bricks when they were building properties with the Indians. And I was trying to get this older, nicer woman to sign this contract, and it was a Friday night, and they're partying, and I'm sitting there in my bed, and it stunk. I think there was bed bugs in there, and this place was a shithole. And I'm wondering to myself, what am I doing here trying to buy this mobile home park? Am I really on the right path? But despite the doubts, I stayed persistent and I focused on the relationship. The whole goal is to build trust. I was committed to this deal, and I know Donna wanted to do the deal with me. I literally went to her nephew's hockey game. I got to know her family. I built that trust, and then she reluctantly agreed to my financing terms. I must have looked really inexperienced. It was unbelievable, and she actually said yes. When I look back at this situation and in that moment where I felt doubt or unsure and I was needing to move forward in this business, it reminded me of a drill that I learned on the first day of freshman football practice. It was called Okie Dives. It's a do-or-die type drill where two guys are facing each other. They're full on with their pads. There's two parallel lines drawn on the outsides of them. This makes a funnel or channel forcing you to go towards each other, and you can't go outside these lines. One guy's got the ball, the other guy facing him has to hit him and tackle him and knock him down, and then you find out who's going to go forward or backward. There's no room to go around him. You either knock him down and go forward, or you get knocked on your ass and you go backward. So there's nowhere to hide. There's nowhere to get out. You have to face the obstacle head on. This deal was the culmination of 3 years of hard work and learning the ropes, understanding mobile home parks, building that database and going to Nebraska and building that trust, borrowing from friends, working with an investment partner, and then finally buying a large mobile home park with every last dime that I've saved. It took a lot of heart for me to push through the obstacles in front of me. And this time I didn't back away. I didn't let the fear or being timid or hesitation cause me to run away. I wasn't going to lose the battle. I pushed through it. I moved forward, just like the Okie Dives. I had to take that attitude. If I lose all my money, fuck it. I'll do it again and again and again, and I will win. That was a huge step for me. Instead of letting the fear control me, I controlled the fear. It's true. I always loved defense. I love hitting somebody, no matter how big they were in football. I'd rather be a little crazy and give it all I got and get knocked on my ass than shy away from adversaries and play afraid or be hesitant for the rest of my career. That was my attitude growing up in sports, and it's still my attitude today. And that's life, isn't it? You need to step the fuck up and deal with something, or you run away from it. And if you run away from it, life eventually catches up with you, and it will knock you on your ass anyway. There is nowhere to hide. You might as well face it head on, or it's going to come back and make your life miserable. That decision to go for it was the game changer. That was the pivotal moment, and that investment catapulted me to new levels in my career because I stepped up to the challenge, I pushed through the fear, and now I actually owned assets. Now I'm a true investor. A bird's eye view. Take a step back and look at your plan and your current path and ask yourself, is it working? When you need to stay the course, you need to also make that judgment call on when to pivot. This doesn't mean giving up, it just means adjusting so that things work better. As you listen to this book, you may be considering if being a full-time commercial real estate investor is the career you want. This is more than just investing on the side. It's a fully committed lifestyle, as you can see. Personally, it's what I chose and it's what I love, but you may choose to do things more passively, and that's an option too. As I move into the third quarter of my investing career, my growth into private equity funds provides me an opportunity that I can continue my investing success. I can keep growing my company. I can keep buying assets. And it's an opportunity for others to share in the cash flow and the tax advantages as being a passive limited partner. With this book, you can make a more informed choice about who to invest with and understand how it's done and what it takes to be successful in investing. In my fourth quarter, I can see myself stepping back from driving every aspect of this business. Scaling is the first step towards that, teaching my team how to get the highest returns possible, setting up the business to run without me, and that's a whole nother learning experience I'm dealing with right now. But if your goal is to be an active investor and you want to be hands-on with the growth of the commercial real estate business, you got to teach your team what to do so they can run the business for you as you can focus on the strategy and the goals that you're striving for. As your team gains expertise, you can truly be the CEO and then let your leaders run those divisions of the company. Then you're allocating capital and you're acquiring talent and keeping your eyes on the priorities rather than getting stuck in all the minutia of the little day-to-day aspects of the business. Timing. Nothing's bigger than understanding big market trends like booms and recessions. Keep zooming out so you can try to see the big picture. If you get stuck in those little details, you're going to drive yourself crazy and you'll miss the big stuff because you don't take the time to build a solid strategy. Of course, you'd like to perfectly time the market so that you could sell when it's at its peak. It's a seller's market. In real estate, we call it you sell to the proverbial dumb California 1031 buyer who's out there recklessly investing their equity in any competitive market. You're not going to time it that way. Yet you can time when you want to buy, and you want to buy in a buyer's market where there's less competition with fewer buyers, less investment capital looking for yield, and higher interest rates that deter buyers from even wanting to compete or go in and invest. But none of us have a crystal ball. Focus on acquiring properties that work in both up and down markets. Recession-resistant assets with positive cash flow are the key to the real strategy. Execute on your business plans and you'll maximize the value and make progress towards your goal. It's all about focusing on what you can control. If the market's down when you want to sell, then you hold it. Continue to pay down the debt and collect the cash flow. And if the asset's ready to sell, then do the calculation. What I do is I look at 10 years of cash flow. What would that total up to be? And if I can make that on a sale today and go reinvest that money and get a better return elsewhere, I'm going to sell the asset rather than holding that 10 years of cash flow to get that return. This concept is true for me because I'm actively investing and developing new opportunities all the time. There's always something coming up ahead. It's different for people in later phases of the game who just want to sit on the asset, not worry about reinvesting into another opportunity or creating or forcing value on their assets. So to be clear, the impetus of why I'm selling is because I'm actively investing and prospecting and I want to move on to another value-add opportunity. It's all about the velocity of money. I learned this from my mentor, Scott Scheel, but there'll be a time when I don't want to keep selling and looking for another value-add project. Then that 10-year formula doesn't apply. I would rather own the assets, continue to get my distributions, and not keep selling. It comes down to a choice, finding the answer to this question. Does holding the asset give you the return on equity and peace of mind that you need to support your lifestyle goals? The worst enemies of an investor are your emotions, fear, and greed. The worst comes out of me when I compare myself to others. It takes me away from my inner focus and it puts my focus on the external material things. This would be comparing myself or judging my status or success in comparison to someone else's. This is a complete waste of effort, energy, and it truly does affect my performance for the negative. Now, I don't really care what anyone else is doing. All that matters is what am I doing and how can I control that process? It truly is toxic and diverts you from your mission and your vision, so just focus on yourself. All that matters is it's you against you, no one else. Doesn't matter what anyone else is doing. Investing is truly an intellectual sport. Very little emotion, if any, is needed to make logical calculations about what the best ROI would be when analyzing investments with conservative assumptions. This is simple accounting and math, yet the game of working with people is full of emotion. The market and how it affects the investments you are investing in are far from rational, as we know. This is truly an inner game that we play. The end game of business is about profits and cash flows, where the language is accounting and the scoreboard is your financial statements. At the same time, behind the game is communication with people. This is why we watch movies like Game of Thrones. It's the inner workings of the give and take, the compromise, the power struggle, the attraction, the egos, the motives, the drives, the fears, and the desires. This is the human drama that's played out, and accounting and a return on investment. These are the bottom line analysis as the foundations of keeping score. Once you know what the outcome of the commercial real estate game is, which it's buying profitable and cash flowing assets, period, and you understand the field that you're playing on, which is the marketplace, then you know, and you understand the field that you're playing on, which is the marketplace, and you understand the field or the board that you're playing on, which is the marketplace, and it's comprised of people you must work with to get those assets. With your scorecards in hand, your balance sheets, income statements, and cash flow statements, you can really play with the levers and motivate and drive people to make decisions that help you win the game. The assets are owned by people. You acquire those assets through the people you communicate with, you partner with, and you buy from on a continual basis. If you have a scarcity mentality that you're never going to find a good asset to replace the one that you sell, then you're always going to be stuck because your beliefs don't let you grow to the point where you're truly wealthy. Sometimes you need to sell to avoid a bigger loss. If you look clearly at the market, you can see when buyers are buying rationally and when they're buying irrationally, paying premium prices for small yields with a huge amount of work needed to generate that cash flow. You've got to consider letting go of the asset and selling it at a premium because these windows of time in the market don't last forever. The market will shift and values will decrease, times will get hard, and in those moments, you don't have a lot of room for error. Never forget there's a massive world of abundance in commercial real estate investing. If you get stuck on an idea that you have to have one deal and one strategy, you'll make poor decisions. Look at each opportunity as objectively as possible through the lens of an abundance mindset. This is a critical attitude you must have to win the game. If the property loses occupancy or your rental rates don't increase as aggressively as needed to maintain profitability, or your interest rates go up over the next 5 years, investors don't have enough of a buffer to sustain the hard times and will default on their loans, or they'll just get tired of having their capital tied up in a deal with no returns. In those situations, investors will eventually want to sell at a loss or recover what cash that they have in the asset. Keep in mind, now this advice is for an active investor who's looking at hundreds of deals per year. If you're not actively in the business and your commercial property is your retirement, then there's no need to sell the property at all. Let it continually perform, pay down the debt, secure long-term low-interest debt, and then in 10, 20, 30 years, you have an unbelievable asset that will generate cash flow for you and your family for generations to come. What goes up must come down. And just a reminder, since the Great Recession of 2008, and as of writing this, we've been on a bull run 10-year commercial real estate decade that has not gone down in value, so some kind of recession is coming. There will be a temporary downturn in the market, and I'm preparing for it, and I know you should too. There will be an opportunity, as there is in every decade or two, when you'll find buying opportunities of a lifetime. You must have the cash or connections to capitalize on these events, and you must be able to take advantage of them in that timeline. Even if you can see it happening, if you don't have access to capital, it's not going to help you and you're going to miss the opportunity. You've got to start preparing for it now, 1 or 2 years in advance, in order to have that capital ready, the lender relationships, the investor relationships, so you can pounce on the best properties at the most ideal time. I haven't had a lot of luck with the strategy of buying foreclosed on properties, but banks will take properties back. And I'm going to build relationships with asset management departments in those banks that will have the quality assets to sell to strong commercial real estate operators. If you can create those connections ahead of time, they'll want to work with you rather than some guy who has a little bit of money but no idea what he's doing. By no means do I have an in on this or I understand this game that well, but it's something that needs to be noted and a strategy I'm going to continue to go after. Pay attention to the changes in the tide. The traditional real estate advice is location, location, location. We've all heard it. But just as important is timing, timing, timing. This business is all about timing. I believe all these assets with inflation are going to go up for the next 10, 20, 50 years. But if you buy in the wrong time and you can't cover the debt, you're going to lose the asset and it's game over. You can own a highly desirable property and even have an amazing vision for it. Yet if you can't weather the storms of the bad times and hold the property during these periods, you'll get buried in this business. Stay the course to win and make good decisions. So I said it before and I'm going to say it again. Complexity kills execution. If something seems too complex, there's a problem. You must be able to understand any property investment or deal structure by simply writing it down on a piece of paper. This goes for all levels of business. Have a clear and simple plan that you'll continually reference. I like the 80-20 rule for this. Focus on the core things, the 20% that matter, the drivers, the levers that get 80% of the results. This is the essential. This also helps you avoid analysis paralysis and overthinking on items that don't really matter. Your plan must be somewhat simple because you're going to need to be able to think on your feet. Things don't always happen the way you envision them, so in your mind, you must have a clear framework of what the main deal points are. So if there are unexpected changes in the construction costs or the capital improvement budget, your partner's bringing in funds or lack of them bringing in the funds, or a change in the loan terms from the bank, you'll need to have a general concept or idea of how it affects the overall transaction. Now, don't get me wrong, you have to know how to model it and you have to see the nitty-gritty numbers on the spreadsheet. But if you don't understand the concept or framework of the deal and how these big drivers affect the actual returns, you're going to be confused when you have to make those decisions. It's simple. You have to see the cause and effect. You'll know immediately, okay, these changes actually do kill the deal or they keep the deal alive. Here are some of the 20% of the things in this business that I focus on to get results. Number 1, the acquisition. This is structuring the deal for the seller to make it a win-win. Number 2, for the partnership. This is structuring the deal with your capital partner so they're happy and you're happy as the sponsor. Number 3, for the operations. You need to focus on the monthly management reports and financials. Number 4, with your staff. This is creating simple systems that they need to focus on continually. We call them the critical drivers, the priorities in their departments. Number 5, most importantly, to maximize the property investment, you have to focus on the critical processes of collections, auctions and evictions, expense management. This boils down to income and expense. You got to collect that money. If they don't pay, get them out and then keep the expenses tight so you can make the most on your margins. With systems like this, you're going to be able to stay the course. Personalize your systems, memorize them, and then execute them the same way each time, refining them over the years. You're going to be light years ahead of the competition because you put the time into the framework and understanding the main core fundamentals that drive your business. Play the long game. The timeline can be long in commercial real estate. It took a decade for me to really understand just the basics of the industry. A decade. I wish I could say it was faster, but in order to grow in this industry, it just takes time. Understanding the core principles will shrink that time frame. Generational wealth, like real wealth, however, is created over decades, not in just a couple of years. So keep that in mind and just be patient. It will work out if you just keep at it. Chapter takeaways. Staying the course is really about navigating. Make a habit of stepping back from the day-to-day grind regularly to keep the right perspective. Focusing on little details and hitting small daily goals is the key to a long-lasting, successful career. Little wins, get those little wins. When analyzing deals, focus on the core things, the 20% that matter, the essential, the drivers, the levers that get 80% of the results. It must be simple because you'll need to be able to think on your feet. Focus on acquiring properties that work in both up and down markets. Recession-resistant assets that cash flow are the key to a real estate investment strategy. This approach removes considerable risk. People forget that real estate does go down. If you buy a bad investment, it is catastrophic to your career. So cash flowing assets are critical to taking a risk-adjusted approach to being a consistent, successful investor. A journal is a great way to take stock and clarify your thoughts. Start by simply writing down what's on your mind. Ask yourself those critical questions. Focus on some problems that you're facing. Think about and focus on some of those good things that are happening to you right now and that have happened in the past. Highlight deadlines and results that you're working towards in those small, manageable goals that'll get you to the ultimate vision and goal. Revisit those plans that you've made, and as you think about the challenges that you face, you can step back and you can see that bigger picture on how important those challenges are, and they allow you to learn and develop your skills in the commercial real estate game. If you don't go through this process, you don't evolve and you don't change, and you're not able to handle more adversity, more obstacles, more challenges, because you're going to get it. As you grow in this game, it's only going to get harder, but you build up that capacity along the way to be able to sustain and handle those obstacles. So be sure to keep in mind the lessons that you've learned and navigate and change that course. As the market shifts, you shift. As your investment appetite or your personal goals shift, you're going to change your business plan. So consistently focusing on it will allow you to shift so you're not going in the wrong direction at the wrong time because you never really questioned what you're really doing or why you're doing it. It's okay to ask those questions and navigate and shift the course. Edge Principle 4. Never get too high, never get too low. Enjoy the roller coaster ride, baby. Deals will fail, your closings will get delayed, zoning won't get approved, someone on your team will forget to do something and then the whole deal falls apart, or a seller just decides at the last minute they're going to pick someone else's offer, and after 3 years of work of building that relationship, they end up going with someone else. It's all okay. There'll be lows. Don't let them consume you. Just keep showing up and keep playing the game. This principle ties directly into principle number 3, stay the course to win. You gotta keep a balance in order to stay your course. Consistency over time will mold and shape you as an investor and save you when your plans fall apart, and I'm sure they will. You can't get too low, but you can't get too high either. When I was young, I had to learn this lesson where I don't want to get too pumped up, or you can't expend too much emotion, even on your wins. You got to stay pretty even keel. So when prospecting for new deals, every day I start from zero. Wherever you're at, however successful you may be, in your mind, starting from zero. Previous successes can give you confidence and give you momentum, but don't let that success change your approach when you're trying to find a good deal or build a relationship. Work like you have nothing. Your emotions can run wild. If you're too high, it just wears you out. If you're too low, it'll demoralize you. You can choose how you react, and because the timeline in real estate's very slow, you don't want to focus on the day-to-day peaks and valleys. One of my teachers described it as having one foot on the gas and then one foot on the brake at the same time. You're just redlining, but you're not going anywhere. Continually telling yourself how good you are or how good you'll be, it may be effective for you, but what's powerful and has worked for me, it was telling myself what I won't accept. Once I did this, it helped keep me motivated. It was things like, I'm not going to work a 9-to-5 job. I'm not going to give up on this no matter how crazy this investment goes or how weird this mobile home park self-storage strategy seems to everyone else. I'm not going to go back and live with my parents. No way. I'm not going to give up because my girlfriend or wife or husband or significant other doesn't believe in what I'm doing. For me, the motivation was about sticking to who I am, my identity. Like, I'm not a person who's going to give up. I don't quit. That's it. Maybe the New England background I have has me respond more to negativity than positivity. Like, I'm more driven by pain than pleasure. So do what works for you. A positive approach might be a practice envisioning your goals or imagining yourself achieving success. And that's important, but for me, it's about the standards that I'm not going to accept. And that's what really drives me. It's been motivating for me to remember that there's no turning back. There's no cushy salary or some other game plan that will save me. There's no safe, secure job I can count on. There's no distractions that will make me feel better about who I am in the long term. People have television, booze, pills, emotional dramas. None of these things will fill the void. I know I need to take care of my financial future. This is my responsibility. I'm the only one I can count on to do this. I'm not going to go back to working for someone else. I don't care how long it takes. This is what's going to happen. Whatever it takes. It's a hard line, but this is what works for me. So this means I can't afford to kick back when things are going well, for me to relax and get high on my accomplishments. Or I can't collapse when things get low or when the market's down or it's not as successful as I thought it was going to be in an investment. I can't get depressed. I always got to keep my head on straight, looking ahead at the big picture. Keep your focus on the numbers. As you look at more and more deals, it's easy to ballpark the numbers, and with time, you'll have a good idea what a good deal or bad deal is within 2 minutes of looking at it. And yet, it's easy to get lazy. The real power always lies in the numbers behind the deal, the numbers from the due diligence process, the numbers about the market, and the numbers from your research. There's no sense in getting emotional about the process or about any one deal. You must know your actual numbers on income, expenses, NOI, what are the capital improvements, and the debt terms, so you know the true return on your equity. Then add in your assumptions and be conservative. I have learned my lessons. You want to be conservative, you want to underpromise and overdeliver, and I've learned that lesson through my projections. So when going over some of these assumptions, this is going to include what's the maximum rent increases we're going to get, what is the current potential gross income, what's scheduled to be paid to us based on these current rents now, and then where is that actual income going to be in the next 12 months. You need to see the money that's actually going into the bank account now so you know that that deal, even if it's a good opportunity, you're going to be able to survive with the existing operations in the meantime. Just like a pilot that has a pre-flight checklist, you want to fill out your evaluation spreadsheet so you know exactly what the key performance metrics are. And these to me boil down to cap rate, cash-on-cash return, and debt coverage. If you don't know these optics while you're structuring an offering or negotiating a deal, you're truly flying blind. That's why I find it important to have my evaluation spreadsheet in front of me. That way, I can see the complete picture. What is the current situation? What my year one pro forma situation is going to be? What my fully stabilized year 3 or 5 or 10-year market projections are going to be after the asset has been fully stabilized and we sell it. When you know these 3 scenarios, then you know the potential upside. Then you can go backward and look at how aggressive your assumptions are so you can determine the risk on your downside. If you can't raise rents as aggressively as you want, if you can't eliminate 10 to 20% of the vacancy or another 10% in the concessions that the seller has, if you can't build the $60 per square foot that you're expecting to build at, or if you can't borrow at 3.5% or 4% versus 5 or 6 or 7%, how's this going to affect the overall return on the deal? Can you withstand these setbacks and be patient with the lower return on investment while you continue to manage the asset? That's an important question to ask yourself. I don't suggest you have analysis paralysis. I'm saying get all the information on the table, know the potential upside, and most importantly, know the downside. Know where you're being too aggressive versus conservative on your assumptions, and then make a non-emotional decision about moving forward on the purchase or deciding to cancel. New information will come to light during your due diligence process, and if you know the numbers, you can decide intelligently, not emotionally, how you want to proceed. With the new information, do you renegotiate the price or the terms? Do you push on and deal with those issues that you found, or do you push back and do you have the seller fix those issues before the closing? That's your opportunity to renegotiate the deal. Your numbers will be your guide, and this is how you're going to approach each unique situation by having those numbers and making those adjustments. Momentum. The consistent daily routine helps you go the distance. This may seem unrelated to the secret of success in the game of real estate investing, but it's very important. These recommendations may not all be for you, but many of them are universal, and they'll help you keep a strong, steady flow of energy. And with anything, any goal, you need a lot of energy. That consistent ability to work and not be distracted by problems with your health or your motivation is the key to executing on whatever profession you're in, and more importantly, it will help you make sound, clear decisions. Staying on a more even keel helps you maintain your momentum, and that includes both the inner and outer games. Taking care of yourself physically and mentally is the foundation. Daily momentum includes managing your morning routine. So what do you read? What do you watch? What do you focus on outside of work? And then what do you think about on a consistent basis? It also includes how you sit or how your posture is at your workstation, how much exercise you get, how much sleep you get, what are you eating, what are you drinking, who your partners are, who your friends are, who your spouse is. These things really matter. Mastering your morning routine. So it's easy to glance over this and tell yourself, yeah, I'll do it later, but don't forget that your body supports your brain. Tony Robbins taught me your physiology dictates your psychology, and I truly believe that. Taking care of yourself first positions you for the long haul no matter where you're going. Design your morning routine and look at your yearly goals again. Write down the rituals that work for you that free your mind so you can be in that space where you can get some meaningful work done every day, no matter whether you're feeling high or low. Here's some of the examples of the things that I've done over the years in my routines. I get up and walk 1, 2, or 3 miles. I can bounce on a rebounder. It's a little trampoline. Tony tells you to do that, and you start doing some breathing exercises on there, and you get oxygen in your body. Drink lemon water. It alkalizes your body right away. I drink a certain kind of organic coffee, but I wait an hour. You don't want to drink it right when you get up. Wait 1 hour, and that will help you sustain better energy. Journaling, reading, learning new vocabulary words, getting sunshine and getting your feet on the ground and getting light in your eyes. These things really do make you feel like you have a good, positive outlook on life, and you don't even realize it. My 4x4 daily morning routine. I wish I did this more, and I'm not one of these self-help guys that tell you to do a bunch of things I don't really do, but I have done this in the past, and I delve into doing this consistently, but it's on and off. Number 1, 4 minutes of meditation. So you're going to sit there and just breathe and relax and feel your body and your breath. I don't know any other secret routines about meditation. I'm not good at it. It's just about being present and feeling your body and breathing. Number 2, 4 minutes of gratitude. So this is where I tell myself, hey, I am happy to be alive. I'm grateful. Man, am I lucky. Fuck, like this is a really, really good life. And it's important that I realize that and acknowledge that. Number 3, 4 minutes of future visualization. So I'm looking at my goals and realizing this is what I want for my life and feeling it, experiencing it, enjoying it. Number 4, 4 minutes of reviewing my plan. What do I have to do today? What are some of the tough conversations I'm going to need to have? What are some of the connections in that positive smile or that relationship or that sound of someone's voice where we're really connecting and I'm going to make something important happen? What are those obstacles or those opportunities for this day in front of me? And I have this morning routine. I got an afternoon routine. I got a late afternoon and evening routine. Like I got these consistent things that I do where I don't have to think about it, but I chunk up my day into these 4 areas. And thanks to my team, like my assistants, I'm able to do these things and not be bothered so I can work around the clock. Here's what I do to focus on every day that makes me feel more happy and fulfilled. My friend Neil Strauss, who's a famous author, he told me these 4 things to do each day that will make you happy and sustain happiness. And I believe it. Number 1, focus on your work. This means making progress on your company, your career, on whatever your professional efforts are into. Just focus on that during the day and make progress. Number 2, focus on connecting and socializing meaningfully with a partner, a friend, a family member, a loved one. Obviously, this sounds simple, but some days I get so wrapped up in what I'm doing that it just helps to talk to a friend and just connect on a deeper level rather than just mechanically going through the goals. In the end, it's all about those relationships and connections, and those really fuel me, but sometimes I forget and get mechanical. So investing in those relationships and experiencing those feelings, that's important to keep me happy. Number 3, focus on health and exercise. So this includes doing something every day. It doesn't have to be high intensity. Now in my 40s, I've learned I can go for just a 3 or 4 mile walk or do some stretching or some breathing, get some sunshine. And then I have the other days where I'm doing high intensity boxing or weightlifting, but everything for exercise doesn't need to be intense. Just keep it consistent and do some form of movement every day. It really matters in your mindset. Number 4, focus on learning and creating by reading, writing, learning, with the goal of getting out of my work so I'm not just in my work brain and I'm doing something different, something creative, something expressive. This is great for me because it gets me out of that mechanical movement of only doing work or the same tasks over and over again. And if I push myself and learn in different ways, like I even tried poetry at one point, not that I was great at it, but it pushed me to be a better presenter, deeper thinker, get me more in touch with emotions. Like that changed my perspective on things and it helped me be more happy and more fulfilled. I've learned at this phase that my satisfaction in life is tied to being productive, feeling connected and healthy, and keeping my brain creative with ways I can break through and realize my highest potential. I just want to work on the basics every single day, focus on what I can control, and then forget the rest. On Sundays, I schedule time for thinking, relaxing, hiking. I got to have some downtime so I'm not overstimulated, always looking at a phone or listening to something or watching something. It's time to get away and just be alone with my thoughts. Now, don't believe or think that I have all these routines down or have it all figured out. I described it here in the sense of I'm not perfect. It's not a science. I miss a lot of these details consistently. But when I'm at my best, I do most of these things and I feel great. And at the end of the day, I want to feel happy and fulfilled and I want to make progress. So I have to invest in these areas of my life. The power of your environment. Setting up your workstation. Because you're going to spend a lot of hours at your workstation in the pursuit of these goals, it needs to be set up for comfort and effectiveness. This will help you keep that momentum. Your posture really matters. It means get a standing desk that you can adjust, a quality, comfortable chair, paying attention to how your body feels while you work. I'm not saying you need to stand up all the time. Adjust it up and down, but move around and step away from your desk every 50 minutes so you can breathe and move and you don't get in that funk. Physical strength and structural alignment. This is your posture. Weightlifting is a great thing. Scale to your current abilities, squats, deadlifts, overhead presses, push-ups, pull-ups. These are all you need. However, other machines and weights are good too, such as strength bands. You have dumbbells, you can do other body weight exercises like lunges or presses. What's important is you do something to feel strong. You can't just run or walk. You need to get some resistance training. A simple book that helped me outline the basic core movements were Paleo Workouts for Dummies. Get a trainer to show you if needed. I've used the Paleo Workouts for Dummies book by Kellyanne Paducci, and it provided good guidance for me. Also, I trained really intensely and had some injuries that created some back issues. And if you have back pain, read the book Healing Back Pain by Dr. John Sarno. This book was a true game changer for me, and it helped me heal my back by recognizing that repressed emotions that I didn't really want to consciously deal with. This was actually causing the back pain. I was unconsciously exerting pain in my body, so I didn't have to deal with issues or stress in front of me. It sounds crazy, but it is highly mental. So check on that book if you have this chronic back pain because it might not actually be the back. It's a mental problem that you need to deal with. That's the best I can describe it. I recommend Egoscue. It's a program that teaches you how to keep your posture in alignment. Many people will spend their work days like looking down at their phones or looking at a computer screen, and they do this for years. This really screws up your psychology because your physiology is all out of whack. It creates a lot of stress. So once you can put your posture back into alignment, you actually feel better and you think better because you're not so stressed out from all the misalignment. Hardware and software tools. If you need to set up and make hundreds of calls on a phone line, then I highly suggest you get an efficient phone system. I'm getting outdated here in terms of what technology is going to be best for this system, but some of the ones that we use allow us to track our metrics. That's what's most important. How many calls are you making? How many LOIs are you sending out? How many does it take in order to find a deal? What's most important is just keeping that database either in Excel or in some CRM software or Google Sheets, and then consistently following up with everyone and then having that CRM. We use a program called Podio that allows us to keep track of the follow-up and the different chains of communication with all the different sellers. Some of the things that have also been helpful for us is having an automated voicemail campaign, mailing campaigns, texting campaigns. I can get into more details. If you go on our website, patriotholdings.com/resources, we'll outline some of the activities that we do to go out and find deals. Health and diet. The paleo diet works for me, and I learned a lot of it from Paleo for Dummies. It's in those Dummies books in the bookstore or on Amazon. Essentially, the diet consists of whole plain foods, lean meats, grass-fed or wild if you can find them, fruits and veggies, and lots of nuts. What works for me may be different for you, so look at options to improve your health and still be able to consistently follow a habit of a healthy diet. For me, it makes me feel better to avoid grains, dairy, high sugar, and processed foods. Now, trust me, I go off of this. I'm not perfect or that strict, but now I do avoid alcohol, and I really don't like to eat a lot of processed or any fried foods, and I feel much better for it. But, hey, I love my sugar. I love nothing but cake. God, dessert is heaven. Drink tons of water and breathe deeply. Hydration is a big focus for me, and it's more than just drinking water. Hydration is a big focus for me, and it's more than just drinking water. It's about having the right mineral balance in that water. So I buy electrolytes. I put lemons in my water or lemon juice. I put Himalayan sea salt in the water. Plus, if you can buy spring water, it's better for you than some of the other options. Sleep and activity. What gets measured gets managed. Getting quality sleep and physical activity are extremely important, and using a monitoring device, currently I use the Whoop 4, so whoop.com. It's a wristband that tracks my sleep, exercise, breathing, heart rate, body temperature, and a bunch of other things. But it helps me maximize my energy because it helps me operate in a way where I know I can push a little harder on certain days. Other days I need more recovery. It keeps track. It's almost like a coach, and it gives me consistent measurements along the way so I know if I'm making progress. It operates right through your phone app. I think there's a monthly or yearly membership fee. But for $300 for you to monitor your progress, remember, what's measured gets managed, and your health is critical. So measure your health metrics, and you're going to manage it effectively to be effective and produce the highest amount of energy possible in your own body. Supplements, nutrition, and snacks. Your body fuels your brain, and taking care of your body will keep your brain sharp. Focus on giving your body what it needs to be healthy. So daily practices like green juices, but low sugar. Don't just drink regular refined juices, low sugar juices. Healthy snacks and daily exercise habits all support your body. Your health, physical and mental, is directly related to your performance, and that's directly tied into whether you get too high or low with your emotions. Keep that homeostasis in your body, in your business, and then you'll keep it in your mind. Journal every day. I talked about this in principle number 3. Ask yourself, what am I feeling today? What are my goals and plans? What are the strategies that I'm going to use to win this game of life or this game of business? A little introspection helps you stay on an emotionally even keel. It sounds so simple, but sometimes we don't take the time to actually think it through and feel it. Write it down. Sit there with your own thoughts. I've been doing this since I was 17 years old. I've written in tens, maybe hundreds of journals. I have boxes of them everywhere. It can be better than going to a psychologist, and it's very therapeutic. Get it all out. The ups and downs, the wins and losses, the relationships, the failed ones, the successful ones. People will disappoint you. They'll excite you. This is the human drama. You must process all of it in a way that doesn't take away from how you want to live your life, who you want to be, and what you want to be and create. Processing it on paper is a lot more effective than looping it over and over in your mind like a hamster on a wheel. You got to get it out there so that way you don't hang on to it. Practice gratitude and resilience. So we all face challenges, and some of them in the moment seem insurmountable. Sometimes we fail, we make a bad decision, and it costs us dearly. You can't go back and change it. But there's always good things to focus on in our lives too. This topic is part of Principle 3, Stay the Course to Win, and it's rooted in maintaining a balanced perspective as part of Principle 4. I try to regularly count my blessings in some way. I want to keep perspective. I'm so damn lucky to have these opportunities. People love me. I have a healthy mind, a clear mind. I have a healthy body. I can move around. I can walk. I can feel. I can talk. I can move. When I lose sight of this, negativity creeps into my psyche, and then I just focus on what I don't have. Then I feel mad and angry and short with people. There's so much that I do have, and that makes me feel great. I feel more warm. I feel more connected to others. If you're really going through a lot, then revisit the last chapter, Stay the Course to Win. And as you think about the challenges you face, you know that there's another way that things need to be done. Sometimes the problem isn't as bad as you think, or you only thought there was one approach, and there's a lot of different approaches. Nothing is binary. Nothing is if this or that. There's always at least 3 options. So you can step back and see the bigger picture on how important or unimportant that challenge is facing you, and then make that decision knowing you have an abundance of options. You're not boxed into just one situation. How do I think about the business of real estate? So when I look at real estate, I believe there's an offensive and defensive mindset, just like sports. Ultimately, distractions must be removed. Blocking out the day for focused prospecting is a must. I think you know that. I've said it over and over. I don't care what stage of business you're in, you gotta do this. Like in sports, staying on course and using momentum is your best friend. At different moments of the game, you'll need to employ different strategies. Sometimes you must be in attack mode, adopting an offensive mindset and playing a little more recklessly or aggressively in your acquisition process. When I had nothing, I would say to myself, come on, Jer, I've got to make something happen right now. Keep it simple. Don't overcomplicate your strategy or mindset. Push forward. I don't care what part of the country I'm calling or flying to next. I know exactly what I want. I'm not exactly sure how I'm going to make that deal happen, but I'm going to find a fucking deal, no matter how many offers I have to make to get there. You not only attack on your acquisitions, you must push the offensive mindset. Attack the plan to raise rents, drive your collections and income, attack your operational plan so you get better at customer service, attack your plan to raise funds from capital investors. This is a mentality and attitude where there's no fear. You're on the offense and you're aggressive because you know you need to make things happen. You take action. Sometimes when raising funds in particular, I can be met initially with resistance from investors, or even internally, I was resistant to asking for money. I've learned how to push through this, though. It's important where I have to make confident presentations, being honest and bold, even when I'm not received well by the people that are listening to me. This needs to be conveyed so they know I have the confidence in my plan and I'm going to make this thing work, that this is a great investment. I've done this so much that now I love turning it on. Internally, I have to say to myself, I know I'm doing the right thing. I don't give a shit what happens. I got to step up and take action. If I don't make something happen, who the hell will? So come on, let's go. It's the Okie dives all over again. I step up, I knock life on its ass, or life's going to knock me on my ass. What is it going to be? At other times, you need to play a defensive role. You can't always be an offense. Protect your position and plan and stabilize for the long term. This could be things like contesting your property taxes to lower them, cutting your utility bills in half by charging them back to your tenants. Cut down your management payroll costs. Lower your maintenance and repair costs by finding different vendors that can do the job and you don't need to keep those people on payroll. It may mean, in some instances, holding back on distributions to investors and preserving capital for the property, allowing you to make those improvements just in case there's emergencies. Investors won't be happy, but you need to preserve the asset first and then take care of the investors. When you hold back those distributions, you're not going to be popular with those investors, but they're going to respect your decision because you had the foresight to have those reserves and make those improvements needed to ultimately make the asset successful. Special teams. So just like in football, some aspects of the business don't fit well in the offensive category or defensive category. So I think of them as special teams. You're working with specialized contractors or project management teams in your company, making sure you focus on the details and you follow through with the objectives. There are times when you need to focus on property improvement projects like reconstructing roads, building new signage, constructing storage units or expanding, improving your property's infrastructure like the water lines or sewer or power lines. These may be tied into your value-add strategies, and this is where the details are very, very important. If you're not a football fan, special teams are the players who can really make the difference in the game. You don't need them too often on the field, but then when you do need them, they need to deliver in those critical moments, like kicking a game-winning field goal or returning a kickoff or running it back for a touchdown. You don't see them too often on the field, but you do need them to deliver in the most critical moments, like kicking a game-winning field goal or returning a kickoff and running it back for a touchdown. They are the difference makers who can completely shift the momentum of the game. Your project management team and trusted contractors can make the difference in your projects, literally making or breaking the property as a successful or failed investment. Whether you're playing offensively, defensively, or doing something completely out of the blue, you need to have your goals in mind and stay the course. These routines, the habits, the mindsets, this will keep you focused through the highs and lows of the emotional game of making and losing lots of money. Like any driven person, I tend to obsess over things. I have a tough time relaxing sometimes, believe it or not. My mind loves to bounce around, continually thinking about how I'm going to structure a deal, or what the best way to run the company is, or what strategic partnerships should I form. I have all these ideas in my head, but most of them never go anywhere. I'm always more comfortable when I have a simple, narrowly focused goal in front of me. If I think about too many things at once, I get distracted, I get concerned, and I'm less effective. To give my mind the clear, simple goals I know it works best with me, I must have two things to keep me on track: an organized system to outline those simple goals, a reference or an anchor to keep me continually focused on those goals. Find that one big domino to knock over, and then if I can keep that one thing in mind, I'm going to be able to work on it over and over. This helps me achieve my goals much quicker than continually being distracted by multiple goals at once. Throughout my career, I've had a sequence of small goals that have evolved to bigger goals. In the beginning, it was $5,000 a month in personal positive cash flow. I achieved that. That was step one. My next goal was $10 million of capital gains, and I achieved that when I sold the mobile home park assets in 2019. My next goal is to create $150 million or more of value for the GPs for my company and my partners in order to maximize my personal goals over the next 5 years. These are crystal clear, and I can communicate that vision and that goal to anyone so they know this is exactly what we're after. The business is the business. There are hundreds of tasks to work on at any given point in your day, but when you look at the actions needed to acquire another property or to build your business, then you can narrow your efforts to know these areas of focus. These are the few key things to focus on every day that actually make the difference in your progress. One of my favorite routines that really helps me keep on task, especially when I'm managing so many different people and so many assets, I think we're up to 100 now, it's called the 5 to Thrive. These are the 5 phases of real estate investment, the 5 key areas to focus on when building a commercial real estate investment company. Number 1, acquisitions. This includes the due diligence. This is where you get the deal flow. Without this, you have nothing. So get out there and focus on acquisitions and finding great deals. Number 2, raising debt and equity. You need the money. Once you find the deals, you got to focus on how am I going to create the best capital structure to raise money for my investors, and also the best debt structure where I'm going to be able to borrow money from banks or institutions. Number 3, management and operations, aka asset management. The money's made in the management, your team, your systems, your tools or softwares. This is critical to maximizing the value of the assets. You have to keep your mind focused on the business of management of real estate. This is the difference that makes the difference. I've seen a lot of people in this game, and the truly great ones are the ones that focus on the management. It's not the most fun part of the business, but over time, it creates that separation where you make the real investment returns, the large, consistent returns. And if you don't focus on management, you just don't. Number 4, construction or capital improvements and project management. This is that key team of vendors or project managers or staff that are doing the physical improvements. I mean, this is still real estate. Things actually have to get built. So you have to have people that understand it, from your engineers, your contractors, your pavers, all the different guys that are included that are going to help you actually build the product if that is part of your strategy. Number 5, accounting and reporting, including the bookkeeping. Your reporting is critical as you grow. Your investors want to know what's going on. Your banks want to know how are the assets performing. And internally, you need to know. You need your scorecards to gauge how you're going to make decisions. The reporting is critical. I look at these like they each have one finger on my hand that I can focus on. That way I can easily look through the day and go, okay, what am I doing to build acquisitions? Who do I need to focus on in order to raise more equity or debt? How do I manage these assets effectively? Who do I need to hire? How am I going to get this project done on time and on budget with my construction team? What's the accounting and reporting that we need to focus on to make sure we can make good decisions and our investors know what's going on? If you want to make it a little more complex, you can add a 6th item in there, and that's your marketing. I think of that 6th area like it occupies the palm of my hand, and that encompasses 3 different parts of the business. Number 1, you have to market to go find deals, right, in the acquisitions. You need to market to potential sellers. So when you think of marketing, there's 3 buckets you need to think about. Number 1 is in your acquisition efforts. You got to have someone going out there and getting these opportunities by marketing to potential owners you're going to buy from. Number 2, you have to market to investors, and you have to communicate with investors. That's a big job as you take on more properties, more investment. They want to know what's going on, and those packages need to be polished, and those presentations need to be dialed in. And the 3rd bucket is marketing to your actual tenants or your customers. It's a lot of work to manage your storage units, and it takes marketing expertise to make sure that people that need storage get the message and they find your storage property, or your mobile home park tenants know that you have homes for sale, that you have empty lots, or that there even is a community there that you're offering for people for affordable housing. By compartmentalizing and segmenting out the business in these 5 or 6 areas, you can survive through any highs and lows because you're not scatterbrained or all over the place. Coach Bill Belichick, the all-time greatest coach that's ever lived, the coach of the New England Patriots, the way he coaches his players, it's been said that he tells them to focus on the 3 most important things. This is exactly what they need to focus on in their position, and he doesn't confuse them by giving them more. And I believe this is a great business approach as well. Even if you have to expand the list to 5 or 6 items, you know these are the areas of the business I have to get great at. Keep bringing your focus back to the most important aspects of your business. This is going to help you keep bringing back the focus to these most important aspects of the business that continually need constant execution. Case study, Harrisonburg, Pennsylvania. Years ago, I worked on acquiring a mobile home park in Harrisonburg, Pennsylvania, and I prospected the same owners for over 5 years. After finally meeting with the seller's attorney and I had all the different family members in the attorney's office, we got everyone on the same page and they were in agreement on the deal points. Then I got in the plane to fly home that night, and then the attorney died over the weekend. So when I got back to Las Vegas, the deal was clearly dead, and I feel bad for the attorney. But all that time that was invested into the deal, it just got canceled out and the estate was ruined. None of the other people were in agreement after the attorney passed. So no one was returning my calls. And then finally, after 9 months, we got a hold of an attorney who ended up giving us a cell phone number to one of the family members in the estate. Ended up, he was hiding away in Palm Springs, playing golf. He was basically retired. He didn't want to deal with any business. But after that, I got a hold of the guy, built rapport on his cell phone while he was on the golf course, and then pulled the deal back together, got everyone to agree, and then in less than 2 years after we finally bought that property, we improved it and sold it for $1.5 million of profit and made our investors extremely happy. What it took was consistency where I emotionally didn't get too high or low when I had the deal signed up or when the deal fell apart and I couldn't find the owners. I just stuck with the plan, and over time, it all worked out, and that's how I have to operate my business every day. Chapter takeaways. Your ability to think and function under stress or not is directly related to your mental and physical health. Build a foundation of routines that will keep you feeling good, keep you feeling resilient, give you a mind that is unbreakable, and you continue working hard even through the tough times. Include spending time with friends and families in your routine. Even when you don't feel like you want to do it or you have a lot to work to do, invest in those relationships. This will help keep it all in perspective and give you that energy over time where you feel that love, that connection, that caring, where you want to go out there and go work harder because you have those relationships. Staying on a more even keel emotional level helps you maintain your momentum, and that includes both the inner and the outer games. Take care of yourself physically and mentally, and then you won't be shaken by all these roller coaster up and down emotional swings. You have that nice, consistent stability, emotional mentality. Knowing when to pivot and change course because just something is not working or that strategy isn't effective versus knowing when to keep going because it just takes a little more time. This is a judgment call that requires continual evaluation that you're executing properly. Sometimes you can be right on track, but you just need more practice, better skills, or just more time. Other times you need to change that strategy or course. It's up to you to have that self-awareness so you can make that decision. There'll always be people, small wins, and events in your life that you can be thankful for. Regularly count those blessings in some way to keep your focus on the positive and never underestimate the power of gratitude. People have it really challenging out there. Don't forget that. Remember all the good things you have in your life. You'll need to employ different strategies. Sometimes you must be in attack mode, adopting an offensive mindset and playing a little more recklessly or aggressively. At other times, you need to play a defensive role, protect your position, and plan and stabilize for the long term. They both have value in the game. Know where you're at and move forward accordingly. Look at the actions needed to acquire your next property or the next actions to build your business, then narrow your efforts to these areas of focus. These areas of focus are the few key things that you need to think about every single day to actually make the big difference in your progress. The 80-20 rule. Don't ever forget that. What is the 20% of your activities that are essential that are going to give you that 80% of results? Here we go, baby. Edge Principle 5. Real estate is a relationship game. The power of your word is the key to your relationships. No amount of money can overcome misleading or bad behavior. Structuring partnerships only works when people stand behind their word. This is the foundation of networking, and your network can make you very wealthy, especially if you don't come from any money. It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. Warren Buffett. What happens when you look out only for yourself? Well, you burn bridges, limit your options, and sometimes catastrophically. Natural motivation versus bad behavior. There's nothing wrong with looking out for yourself and maximizing your own interests. Selfishness is a core human value, but my definition of it is not what the general population associates with the word. Being selfish does not give you the right to take what you will, treat others poorly. My approach aligns with Ayn Rand and her school of philosophy, where when one knows oneself, they don't need to take maliciously from others. Instead, they are fair and equitable because they are operating from a highly evolved state of being. They know who they truly are and what they really want, and they don't need someone else to give it to them. It's already inside them. Building and creating something from your own self-interest is what we're made to do and how we add the most value to society. Our self-interest motivates us. We work because we want to work. We give because we want to give. For our own reasons, for our own fulfillment, and not for anyone else's. People who continually live for or do things only for others resent the world and never feel self-actualized. This creates resentment and negativity. Joy and passion come from being free to choose what you want to do and fully express who you are in any method that feels right to you. This philosophy is a complicated subject and creates contention in others when I discuss it. The real message here is there's nothing wrong with getting yours, but do the right thing while you're getting it. Deep down, we all know what that is. Stand behind your word so that your character is far more valuable than your bank account. The best partnerships I've had were based on handshakes. Things may change in a partnership, but I don't try to weasel my way out of things when I made a commitment, whether it's in writing or not. Partnerships. Get it in writing. Money changes people, and money changes minds about people's memories as to how things are. Even when you're standing behind your word, you still need to get things in writing because this is the only way you can litigate or reinforce an agreement. Talk is just talk, and ultimately it means very little in the eyes of the law. Getting any agreement in writing is a must. No matter how much money you have, you'll need to raise funds from other people in the commercial real estate industry. Gary Rappaport's book, Investing in Retail Properties, is a great resource on how to structure commercial real estate partnerships, including private equity funds. He does an excellent job of outlining how a commercial real estate sponsor or general partner typically structures their deals. The book lays out how the limited partners, the investors, get paid versus how the general partners, the people putting the deal together, get paid. That is, once the property or business is profitable, how the partnership splits up, in what order do people get paid. The first thing you need to know about commercial real estate partnership is always two questions. What is the total capital to be raised, and what's the general partner's track record? This helps you, as the investor, understand where they're coming from. Are they a level 3 when you are a level 2, meaning they have more experience than you? I'll explain in more detail the specifics of how I structure my partnerships later in the principle under the section called Leverage Relationships to Buy Property. So as an investor, you also want to know the answers to these questions. They're very important if you're considering investing in a real estate deal. How much will I own for my investment? What's the timeline when I get my money back, and when will you sell the investment? What happens if I need to liquidate my position? How can that be done in this investment? How do I get paid in this investment? Who's managing the asset if the sponsor or the GP isn't there anymore? How much money is the sponsor personally putting into the deal? What are the major risks? And how does this affect my tax situation? These items should all be outlined in the operating agreement for any partnership between individuals or a private equity fund. An example term sheet for a private equity fund or offering can also be found in the resources section of our website. So you can go to patriotholdings.com/resources and you can find sample private equity fund offerings. Teamwork can be a beautiful thing. Now, I don't want to be the guy who reminisces about the glory days of high school, but I have to tell you, when I think back to when I played sports, God damn it, I felt so alive. I got so fired up in the huddle when we had each other's backs. I love the game. I love football. But even more, I love the camaraderie of my teammates. And this was built through hard work and common goals that we shared. I just love to play the game, and that bond and connection with my friends and teammates I'll never forget. Teamwork and relationships are a vital part of any football game, and they're just as important in the world of real estate. Real estate investing is a high-stakes game that requires skilled players working together to make the deal happen. There are many moving parts, plus legal, financial, regulatory details that all must be covered. A mistake by one of your team members has the potential to throw the deal. Their roles are all important, and you need to be able to trust them to have your back and do what needs to be done at the right time. Plus, I've learned most successful investors in the industry get to a point where they only do deals with people they enjoy working with, regardless of the amount of money involved. They honestly don't want to put up with anyone's bullshit. I look at great coaches like the New England Patriots' Bill Belichick for guidance in how to lead my team and my business. According to former Patriots quarterback Tom Brady, the best quarterback of all time, Belichick taught him that great coaching comes down to teaching your key players the three most important actions, the three key activities that move the needle and make the difference. Burn those three ideas into their heads. Then, in times of stress and tension, they'll know exactly what to focus on to stay on track and perform. Building a team. The only way to grow in the real estate business is to leverage your time. For me, this meant building a team of professionals to work with. As the business grew, it became clear that my greatest resource was talent in the people I hired. It's critical to hire A players, that's what my mentor Keith Cunningham calls them, because the talent is far more important than the capital you use to make the deal. That realization didn't happen overnight, but it was very important to my success. Ultimately, I built a strong support system with a group of my professionals who had advised me and supported me in the pursuit of my goals. You cannot worry about all the little details. Set up management systems, rules, and responsibilities, and then follow through with using them. When I didn't have the people or procedures in place, I would question it all or think too much about things like, is this vendor going to get paid? This person's not working out and they're ripping me off. What if the property investment doesn't work? If you let those things distract you, the relationships won't get built and you won't grow. Things would snowball into an avalanche if I focused on all the other stuff. Then I could talk myself out of doing the real work that was waiting for me, that only I could do, and I never would get to it. It takes tremendous energy and discipline to do this day in and day out. Once I was able to get the structures and people in place, I had certainty that things were running and I didn't waste precious energy. At the time, things that only I could do included building the partnerships that enabled the acquisitions, making sure the investors got their checks and distributions when a deal got wrapped up or monthly, and then handling, hiring, and firing the different employees. Plus, my primary focus had to be finding the deals, making the phone calls, the investor calls, and refining the lists by looking up names and phone numbers and ages and emails of all these owners that we wanted to buy property from. To help me with everything else, I hired the best people I could and I set up the best systems I knew at the time, paying bills and collecting rents, all with the money that I had. As I described at the end of the second quarter, the first team was not perfect by far, but I learned how to improve the process, and the team that's with me now continues to improve each year, and there's always more room for improvement, but it definitely has been elevated. My role's changed too. Now my most important role is not getting on the phone or making phone calls personally to owners or people that have property that we want to buy from. It's about doing deals. It's about leading my team, working with the other partners and team leaders and CFO, and putting the pieces together to make the deal happen. This is what it takes to fuel the private equity funds we're building. This is part of the evolution of a company and of your understanding of your own critical strengths. Keith Cunningham taught me, as a CEO, you do two things. You either deploy capital or you hire good talent. That's really the main decisions that I make every single day. To build your team, identify the crucial things that only you can do, and then categorize the rest so you can find the right people to do the others. Others can do things like make sure bills are paid, insurance and licenses are filed, learning how the management software works. Having up-to-date financial reporting is critical so you're cognizant of all the profit and losses and assets and liabilities. For marketing, someone needs to figure out how to work with advertising platforms like Google AdWords, how to build websites, how to do all that IT and tech stuff. Once you find the team, hold on to them. They're very important for your long-term success and sanity. Nothing costs more to a company than employee turnover. Do not forget that. Your people are your main asset. List of team members. In addition to the office staff that you're going to have who help you with the day-to-day, you need other professionals that are contractors typically that you trust to do the right things and to complete the deals. Below is a list of additional critical team members you need to play the commercial real estate game, plus more in-depth descriptions of their roles. Bankers and loan brokers. Real estate agents or brokers. Tax advisors. Real estate and transactional attorneys. Third-party report vendors to help you do surveys, environmental reports, title insurance companies. Construction contractors. A real estate coach or advisor or mentor. Bankers and loan brokers. Lenders and brokers are the best relationships you can create because having them on your team can build credibility. They can make financing a breeze for you, and it's well worth it for you to ensure that your team members are paid as well. For your loan broker, just bite the bullet, pay them the 1% of the loan value at the closing. This is fine. The loan broker is your first line of defense with the bank, and they're the one that are going to financially finesse the deal, submit it, and get that bank to buy into the well-created package so that you can get your loan. I highly suggest you use the loan broker. Once you understand the process, you don't need to do it yourself. They're a better in-between from the bank and the loan broker rather than you having to get in the middle of it. I recommend my guys Atlas Capital. Thanks a lot, Alec. He got me all my loans the last 7 years. He's been a lifesaver. Real estate agents or brokers. It's good to have experienced members on your team who know the asset class that you're investing in intimately. Real estate agents and brokers are key. They're going to feed you the deals. You need to be in with these people and build good relationships. These people can tell you that prices are what they're going for, price per pad, or the cap rates in specific areas. This is if you need an estimate of value. Plus, if the other party has a realtor, it's always nice for you to have a realtor and they'll represent you. Larger real estate firms will have a strong list of experienced buyers who typically pay their fees. So as you probably know, the seller typically pays the real estate commissions. So I suggest if you want to sell the asset, go with a big firm. They got a lot of buyers, you're going to get a max price. Smaller real estate firms will have better customer service. So I've worked with a lot of young guys that are becoming realtors, and they were out there scouting for deals for me, and they gave me more attention because they weren't fat and happy in one of the larger firms. So small guys will help you do a good job when you're finding properties. Tax advisor. Commercial real estate investors must find a good tax advisor because this person can maximize the tax deferral benefits you get through real estate investing. This is important, so listen up. As a real estate professional, depreciation is a passive loss you can use to offset both passive and active income. Tax-deferred income gives you more capital, so you can go put that capital to work and maximize your returns. It's not how much you make, right? It's how much you keep, and then how much you can keep investing and compounding. If you don't plan for that benefit or that gain, and you'll be scrambling around at year-end to find a property to offset your taxable gain, and ultimately, you'll make a stupid mistake. Lesson learned. I did this in 2015. I needed depreciation. I had a good year. I had a big gain. I invested in an office building in Puerto Rico and ultimately lost the money on the investment when the anchor tenant went bankrupt and our cash flow went down the drain. I much rather should have bought a good deal that I found myself rather than at the end of the year scrambling around trying to find some other deal that I compromised my criteria and then I made a bad decision. So be prepared, have a good tax advisor, and then you know exactly the repercussions of selling and you can plan accordingly. Invest the time to find this good professional, preferably through a personal resource. I wouldn't go on Google and just search tax advisor in my area. You want someone who's very experienced in commercial real estate. Real estate attorneys, transactional, and partnership. For commercial real estate deals, you'll need a transaction attorney to help draft and review the purchase and sales agreement, and then you'll also need a partnership attorney to draft your partnership agreements. These are two different schools of law. Sometimes one attorney can do both, but you do need to recognize what their strong suit is so you can put the right player in the right position. Third-party reports. For due diligence third-party reports, you'll need a property inspection, title insurance agents, environmental engineers. They'll do environmental reports and check the environmental issues with the property, and ALTA surveyors. These are all critical reports for you to understand a picture of the property so you don't get burned and make a bad mistake. Construction contractors. Finding good construction contractors for capital improvements and expansion or construction is tricky and it takes time to connect with the right people in your area. Definitely get references. These guys can make your life a living hell, or they can make you look like a genius. A real estate coach or advisor. So I've followed the Commercial Academy, commercialacademy.com, and Scott Shiel since 2006. If you're just starting out in real estate, this guy's the best teacher in the game, and he taught me everything, all the basics of commercial property. My partnership with Dave Reynolds was also critical to my growth, and he helped me master my niche in mobile home parks. Always be looking for that mentor who can help you grow, and you have to offer something of value if that person is going to teach you or give you value in exchange. So when I was broke and I had to go learn the business, I didn't go to Dave Reynolds and ask him, teach me this business. I need to know. I went to him and said, what can I do for you? And I went out and found 100 deals for these guys and helped them grow their business. That's how I learned. The seller is a partner too. Cap rates, due diligence documents, and bank loans and different contracts. None of these matter if you don't successfully build a relationship with the seller or the broker who's going to sell you the property. You'll never get the opportunity to do a deal if you don't build a relationship with the seller first. If you start from the bottom, like I did, you must relate to, communicate with, and build trust with the people who have the properties to sell. In the end, this is all there is. One person trusts another to do what they say. Contracts are only as good as the people behind them. In reality, the seller is another partner. They don't always need to like you, but you need to understand how you're adding value for them and then be able to listen and help solve their problems. At the same time, you must meet your own and your investor's investment criteria. Negotiating the offer. So in a real estate deal, there are 3 main key points. Number 1, price. Number 2, terms, meaning when the seller receives the money. Number 3, timeline. How much time does the buyer need to do all their inspections, and how much time is needed to get to the closing table? You must agree to these first before you get an attorney involved to draft up a purchase and sales agreement. Once your offer is received, you'll find out if the seller thinks you're crazy or not. This works better if you're able to get a price out there first so you can negotiate off that price. If they don't tell you that, make your own evaluation and present it with as much benefit to them as you can. A good thing I always like to do when I was talking to sellers is tell them they have such a nice property, ask them, this property's so nice, why would you ever consider selling it? And then shut up, listen, always look for the motivations. I like to ask, are you looking to cash out and pay the taxes, or do you want to get a good down payment and carry a note earning interest on your equity? Or you can phrase it even more simply by asking, would you like to defer your taxes and get a big down payment and then monthly interest payments each month? This will help you understand if they're open to the idea of carrying a first or second note or mortgage. To add value, you must solve a problem. When I started out as a realtor, that's what I was frustrated with. A lot of people were in real estate, but they didn't really understand what they're doing and they didn't know how to solve people's problems. So figure out what the seller's problem is and how to solve it is key. Not taking the time to listen and build relationships is what causes issues for you and your investors, simply because when you don't understand the problems, you truly can't add value. You must learn all about capital gains taxes and how seller financing works and how to understand the cost basis and the state taxes. This knowledge will help you estimate how bad the capital gains taxes will be to the seller. Then you can highlight that information in negotiating seller financing terms or in pushing to close by year end because you have a deep insight into how the tax laws work. Surprisingly, many real estate investors don't even have a deep grasp of these concepts. Being comfortable with this knowledge and being able to clearly explain it to sellers will give you the competitive edge over other investors. Put the time in. That's why you're reading this book. You got to learn it. You must learn how to let them talk and then listen to them. Listening is how you'll learn the other person, how you build the relationship, and how you'll eventually make the deal. I can't tell you how many egotistical people, they're looking at me, but they're just waiting for their turn to talk, and they have no idea what I'm saying. So listen with your eyes, be present. That is a very important business skill. Leveraging relationships to buy property. So leveraging relationships to buy property is twofold at least. In addition to the relationship with the sellers that are required to get the deal off the ground, you're going to need relationships with others who can provide critical parts of the deal when you got to get them done. Relationships with investors help you be creative in getting deals done. When you know what their goals are and the levels of sophistication, you can align your goals with theirs, meaning your investors, whether it's to get capital from them or if you need access to credit because you can't get a loan, or sweat equity in the deal where you go find the deal like I did when I started, or you found a deal that you structured owner financing. Many times I met people at investing conventions and courses, and some of these people became strategic partners. Working together in an investment deal requires a high level of trust. It's almost a marriage. And the people need to demonstrate credibility. You need to know your partners know what they're doing. I highlighted this in the first lesson where you need to know your strengths. So you don't want to have a partner that has the same strengths as you. Ideally, you'd like complementary strengths so you guys can maximize your talents and you guys are successful because you bring something different to the table. How to build lasting relationships. So early on in my career, when I was working with Dave Reynolds, I was on a bus tour and I was sitting next to a couple from Seattle. It was a nice Asian woman and a tech guy. He was a funny looking guy and who I later found out worked for Microsoft. I love you, Angel and Wayne. I was tired and grumpy because of the long plane ride, the boat, and then the taxi trip to Belize. I didn't really want to be there anymore, but I sat behind him and then I forced myself to strike up a conversation. After a few minutes, we hit it off. They were interested in commercial real estate investing, but they didn't have any experience in the space. I continued to keep in touch with them after the seminar. Over the years, they've invested well over $10 million with me and referred many people to me in several different deals. The reason they stayed with me is because the first property they ever invested in was a really rough mobile home park out in Indian Springs, Nevada. It's this tiny desert rat town outside of Las Vegas. And that deal happened sometime after I bought my first big Nebraska mobile home park. But unfortunately, the investment eventually went south. And then after 3 years of hard work, I couldn't make a profit and I had to end up selling it and just get out of it. Some of the details of that story are under Edge Principle number 1, find your value in the deal and your skills. And then that's a discussion on markets, what not to buy in and what markets to buy in. So when we finally sold it, I got a little of our initial investment back, but no profits. I was happy to be free from all the issues that asset brought us. It was an absolute mess. This little town had a lot of drug use, domestic violence. There were people having sex in empty trailers. It was a chaotic circus out there, to say the least. So after that sale, I gave the couple from Seattle what little cash was left over, and I was able to pay back their initial investment. I personally took a loss, but I made sure they were paid in full. I felt bad that they didn't get a better return on their money since their money was tied up for 3 years. Years later, that couple ended up telling me that the fact that I paid their money back and I took a loss on my investment was the single reason they ended up investing so much with me over the last decade. These are the long-term relationships that if you cultivate them openly and honestly, they'll continue to pay off throughout your investment career. Just do people right. If you do the right thing, it's going to come back and pay you in spades. Don't just look at the short term. Investing is a long, long career, so this will pay off. Tips on relationships with clients. And clients, I mean sellers. Remember, as the leader of a real estate company, your job is to do quality deals. You have no company if you don't do this. So don't ever get offended on the phone. It's not personal. Keep following up. Keep calling. Ask the seller or the broker how the transaction's going if they're already considering selling. Keep a good attitude. Be flexible and free on the phone. There's no pressure. It's just a phone call. No overthinking it. I would tell myself, I want to buy the real estate deal. Do you want to sell it? That's all it is. I'm making an offer without a broker. Do they like it or not? No one's taking advantage of anyone. No one's bothering anyone. No one's hurting anyone. I've had many people say, fuck you. Don't ever call me back. And I've called those same numbers back in 6 months or 6 years later, and those were some of the best relationships and transactions I've ever had. I didn't get offended, and I was willing to continue to move forward and ask if they would consider selling their property. People respect that. Over time, if you have the right intentions in mind when you're calling, you keep calling, and then they see that you're committed to the business and you know what you're talking about, their initial resistance and the inconvenience of establishing a new relationship goes away. That's when they start to want to talk to you and eventually do business with you. I've noticed that if you accept them fully for who they are without judgment, many times these sellers, especially the tough ones who rejected you at first, never want to get off the phone because they've become one of the few people in their lives they can talk to. They can completely be themselves without someone being offended or trying to talk over them. This is so damn important. I've built really good relationships with a lot of older guys in business, and they respected me because I just wouldn't give up. The power of relationships and using common sense. Some aspects of a relationship aren't about what you say, they're about what you don't say. Too many people talk way too much. I know you know these types of people. They can't wait for their turn to speak instead of really shutting up and listening to the other person. The more a person has to talk about himself, the more insecure they look. Over time, when it really comes down to it, it's not what you say, but what you do. What are your consistent actions? And we've all heard the saying, actions speak louder than words. How you manage people at a property, when you're meeting a new investor, or how you handle a sale transaction, these are all opportunities to show everyone involved that you respect them and then you treat them well. But I don't actually think of it this way. I just treat people with courtesy and respect. Also understand that there's never a need to show off how great you are. No one cares about this, and it will come back to bite you. I've noticed as I work with large investors and wealthy individuals, they value the relationships and the experiences they have with you, the enjoyment of who you are and the process of doing business, more than they actually value the money that they make on the deal. There are key points in a conversation where stating that you have experience, that you're currently working on similar projects, or you have insight into their property or investment strategy is very important. Sharing that information builds credibility, it builds rapport, and it gives them confidence that you know what you're doing, but it should always be framed in a way that benefits them. People are selfish, and that is how we are wired. I believe the only rule of sales is to frame every aspect of your conversation to show them what's in it for them, because this is exactly what the seller, investor, tenant, or anyone on the other side of the transaction is constantly asking themselves. Selling is not telling. It's about painting the picture of what's in it for them that gets them the pleasure they're seeking and away from the pain they're trying to avoid. They don't care how much you intellectually know, what you've done, or what you look like unless it benefits them in achieving their selfish goals. People do want to know I will execute because I've done it before. I wouldn't want to have a doctor who's never done the surgery on me do the surgery for the first time. But early on, when I didn't have the experience, I could just say that I had partners who did, and this gave the other party confidence. So keep these relationships in mind and salvage every relationship you can. If it's truly a nightmare when you're doing business, always remember what they did and never work with them again. If possible, try not to burn any bridges, but you don't need to work with people you don't like working with. So it sounds like common sense, but I believe all business boils down to relationships, and especially the real estate business. I guarantee you'll need strategic relationships throughout your career. One of the keys to my success so far has been to preserve relationships at all costs, even if I lose a little in the process. Don't burn relationship bridges. Keep smiling. You never know how or when you might run into someone again. You may need information from that seller about their property that you'd never find out if you burn that bridge with them when he told you to fuck off. Or you treat your contractors right and one of them teaches you a new method of construction and saves you thousands or even millions of dollars. Another scenario is an attorney you might have met through a friend who ends up saving your ass on a partnership agreement or a purchase contract, or another investor shares a lending or banking relationship, and that gives you the access to getting a better bank loan, cheaper debt, and more capital. There are so many compounding effects of healthy relationships that have helped me tremendously and enabled me to get to this point in my career. When something bad happens and you have to choose between your first reactions, which may be anger, you got to ask yourself, how much harm is this going to do, and can I just let it go? Letting it go will be a neutral or possibly a huge positive for your career down the road. Venting anger on someone will not only be negative, but it will often have compounding negative effects. This is your choice, your behavior. This is your reaction. You control it. Know the story of the seller. Brokers call this the seller profile. It's vital when building a relationship. A good friend of mine, I started back in 2001 with when we became realtors, Matt Riccadella. He's a very successful commercial real estate, and whenever we do a deal together, he would always ask me, so what's the story? Good deals always have an issue. Know the seller's motivation. Making the deal is about solving the seller's problem. Ask the seller specific questions to help you determine what's really going on. Ask the seller, what's important about selling? When you do sell, what are your plans? How do you like operating the property right now? Do you enjoy the business? Do your kids really want to be involved in this business? What would you do to this property if you were 30 years younger? What are the large items that need to be repaired now? When you get the title report, find out if there's delinquent taxes or liens on the property. This tells you if they're having problems paying the bills. Understanding the seller's motivation is not to take advantage of them, it's to help you understand what they're trying to accomplish by selling, what issue or circumstance is driving this decision. Then find out the way to solve the problem. Also, it helps you negotiate by referring to the seller's motivation in order to reach agreement. In the end, people who've owned property for 10, 20, 30 plus years, they have a hard time letting go. If you can outline how selling will benefit them by meeting their needs or solving their problems, you may have a better chance of working with someone who actually wants to get a deal done. Leveraging relationships and seller motivation. So a motivated seller can be a huge factor in securing a fair sales price. So the first mobile home park I bought was in New York. I bought it in the beginning of my second quarter of my career from a couple named Everett and Verna. I told part of the story already because it was such a pivotal moment in my career. It was a true game changer for me because at the time, my business was flailing and I was trying to understand and learn and getting experience. See, they were motivated to sell because Everett was ill. Verna called and asked if I would buy it and operate the property because she didn't want to take on the responsibility. She was too intimidated by it and wanted the offer immediately, and I don't blame her because mobile home parks are not easy to run. This opportunity landed in my lap because I took the time to meet them face-to-face the previous year. I drove up there, I spent the time, I got to know them, built the trust, but then at the time they weren't motivated to sell and they weren't going to sell it at a price I could buy it at. They knew me and they knew what I could do to help solve their problem and they ended up trusting me. This is a perfect example of how prospecting works. Knowing the seller's situation, including their current motivations, helped me negotiate the price from originally $800,000 down to $615,000, and then they owner financed the property at a note of $600,000 at a 6% interest-only payment for 7 years. This made Verna very happy because it would defer her capital gains, and then she would have cash flow every single month, but she didn't have to worry about managing the park or all the distressed tenants that were in there. If it weren't for my relationship with this couple, the deal would have never came to fruition, and I would have never got my career started because I needed the cash at the time to stay alive. Negotiating tactics. So I'm not a big wheeler-dealer negotiating expert, but this is what works for me. So these practices are all about preserving the relationships and finding a win-win for everybody. If you know they're motivated and the price is fair, just pay it. You don't need to beat everyone up and get the very last dime out of the deal. Just be fair and create a win-win. If you don't get your price, offer a strong, fair price, but leave at least 10 to 20% room to negotiate upward. Some people like to wheel and deal, so you want to leave that buffer in there so you can negotiate. Always, value trumps price. My mentor Scott Shield told me in the beginning of my career, I'll pay your price if you accept my terms. So if you're just starting out and getting a return is a priority, you can afford to do this. These are the philosophies I abide by. If I overpay on a property by 10 or 20%, but I'm able to get the property with no money down and make the improvements to double the property's value, I'll pay that premium price all day. This is the beautiful thing about real estate is you can do these types of deals and still not incur a lot of risk and add a lot of value for you and your investors. A key tactic I use is a seller financing second mortgage. I'll make the offer, and then part of the capital stack will be me having the seller carry a second mortgage behind the first mortgage that the bank provides. This approach isn't for just people that don't want to put any cash down. It gives you as the investors a better cash-on-cash return and preserves more cash so you can use them for the value-add projects. Plus, you have a buffer for reserves if anything goes wrong. And in real estate, something always goes wrong. Now, banks sometimes don't like the seller to put a second mortgage or any mortgage behind the first mortgage, so we go over tactics in other books about how to structure that preferred equity or that seller's second mortgage. if the bank won't allow any junior mortgages behind the senior debt. 6 key negotiating tactics. So these are the rules I live by for negotiations. Number 1, figure out what the other party wants first. Number 2, don't bicker over little bullshit. Just let them have it. If it's a good deal, look at the big picture. Lose a few little battles to win the ultimate war. Number 3, know your absolute bottom line or top line of where you're going to negotiate. You have to know those internally before you go into negotiations so you don't make a mistake on the fly. Number 4, I'll pay your price if you take my terms. So remember the key rules of real estate. You have price, terms, and timing. So you don't always have to get the highest or lowest price to win in negotiations. Keep in mind the other terms that are a factor that can create still a win-win deal. Number 5, be willing to walk away and truly mean it. Know your bottom line and know when to walk away. You can't get tied up emotionally and get into a bidding war. Emotion is not part of this process. It has to be logical. So if you go into the deal organized and you understand where you need to get the property and what you're going to do with it, you know that you can walk away and don't look back. Number 6, keep coming back because time can change things. If you've been in real estate before, you know no deal is done until the check hits the bank. So keep following up, keep that even keel attitude, be positive, don't burn the relationships. Deals will fall in your lap. Even if the seller sold it to someone else, you may get another chance because in this game, deals are never guaranteed. So being willing to walk away can be a powerful negotiating tool. So this attitude is the basic idea of abundance. There will be more deals out there, trust me. The one you're considering at the moment is not your only chance. If the numbers aren't showing a positive return and you haven't allowed yourself to get attached to the property in some way, in all honesty, you can just walk away without hesitation. This idea has been said in many different ways in many different books, but it's very useful for you to keep this attitude. Earlier I wrote, never fall in love with a property, which is the one way of saying just don't make emotional decisions in real estate. I have a harder time buying a house than I do a commercial property because I actually have an emotional attachment to the house. But in commercial real estate, it's all about logic. Make decision with logic and numbers. And if they don't work for you on that current deal, there will be another one ahead. The deal of the decade happens every month. Walk away because you will have other opportunities. And the highest cost opportunity is a bad deal. A quote from character Neil McCauley in one of my favorite movies, Heat, says, "Don't let yourself get attached to anything you're not willing to walk out on in 30 seconds flat if you feel the heat around the corner." What I take away from this is in the beginning, before you get into full negotiations or you acquire a deal, you do not need to get attached to this deal and you can walk away in any second if you find something doesn't feel right about it. So don't get worked up about it. Until you buy that property, you're just dating. It's not a marriage. Before you make that commitment, you can walk away. If there's any hair on the deal, you don't have to deal with it. But once you buy that property, it is a marriage and you can't walk away. So be very careful before you commit to buying a property. Chapter takeaways. Building and creating something from our own self-interest is what we're made to do and how we add the most value to society. Joy and passion come from being free to choose what we want to do and fully express who we are in any method that feels right to you. There's nothing wrong with getting yours, but do the right thing when you're getting it. Stand behind your words so that your character is far more valuable than your bank account. Communication is a core skill. Communicating effectively was critical to my improvement and my ability to build relationships. I learned how to figure out what others needed and wanted by truly listening to them so I could offer them something of value. The only way to grow in the real estate business is to leverage your time. As my business grew, it became clear my greatest resource was the talent and the people I hired. Great coaching comes down to teaching your staff or key players the 3 to 5 most important actions, the key activities, the critical drivers. These are the things that move the needle and make the difference. Burn those ideas into their heads. Then, in times of stress and tension, they'll know exactly what to focus on to stay on track and perform. Know the story of the seller. That's it. Why do they really want to sell? This is the key to offering them value in the deal. Remember, they must be motivated if you really want to get a deal done. Being willing to walk away can be a powerful negotiating tool. This attitude has the basis in the idea of abundance. There will always be more good deals. Remember that. That is a key principle in real estate. There's always more good opportunities. You can't operate out of desperation. You will make mistakes. Preserve relationships at all costs. Even if you lose a little in the process, you don't want to burn these relationship bridges. Keep smiling. Keep an open mind. You never know when you might run into this person again and they might be able to do a deal with you. Edge Principle 6. Trust your instincts. Listen to your gut. Don't be afraid to push forward even though you're uncomfortable working on a new project or in a new area of business that's unfamiliar to you. However, don't be afraid to walk away from a deal if deep down you just know there's something wrong. That deep down feeling is your gut, your intuition, your instincts, and those feelings aren't just fear. They can be warnings or your subconscious or subliminal knowledge telling you there's something wrong with that property, that investor, that opportunity that you need to steer clear from. Fear is a useful tool and it's good to listen to it. Fear heightens your awareness and makes you sharp, but don't ever let it stop you from growing or pursuing an ambitious goal or project. If you put in the work by learning the ins and outs of your asset class or your niche in this industry, and you focus on your preparation, you won't be swayed by emotional ups and downs. You'll definitely have them. As you evaluate a new property, you and your team must highlight the red flags and potential risks, but don't make them out to be more than they really are. Assess the items that could potentially ruin the project or cause the investment to fail, and also build in a buffer when you know these things might not go according to plan, and you know in real estate, nothing really goes according to your plan. That way, even if the property performs marginally, it'll still meet your basic expectations. As the saying goes, the real money in real estate is made on the buy side during the purchase. If you find a deal that's off market and you understand the niche in the market before it's been saturated, everything doesn't have to go perfectly or to plan in order for you to make a great return. The best deals always have motivated parties. People want to get these deals done. I don't want to beat a dead horse on this, but it's critical in real estate. There has to be a compelling reason why they want to sell the asset or why they haven't maximized the potential of it. There can be a multitude of things such as lack of capital, lack of expertise, lack of energy, lack of health, lack of support from their family or their management systems. If you pick up on any of these things, you know there's value and opportunity that's ready to be unlocked. Many times, if the seller's quite sophisticated, they don't have a compelling reason to want to sell, then you just end up spending a lot of your time analyzing the deal, and ultimately they're not going to do a transaction. Plus, you can't meet your value add criteria to drive returns for you and your investor. There's always a story. There's always a story from the seller about why they're selling, and you need to find out what that story is. This is when you don't downplay. The story is the key to motivation, and their motivation is what will get the deal done and over the finish line, especially when things get a little shaky. And if you're in the business long enough, there's always a few things in the transaction that don't go according to plan. However, if both parties want to make a deal happen, they're going to make it happen because they're both motivated. Establish the minimum return on your investment that you're willing to accept for a property and the maximum level risk you're willing to take on. Once you know what you're willing to accept or not accept, you'll have the power and confidence to push through issues or walk away from potential landmines. So trusting your gut doesn't mean you get pumped up and then you act impulsively, you make a decision because you just feel good about it in the moment or because you have this gut feeling that it's all going to work out. Trust me, I've seen so many people lose a lot of money in Las Vegas because they had a hunch or a feeling about a bet, and then somehow at the end it didn't all work out. Using your gut means you're using your wits and your intuition with your wisdom. If you're making decisions on hunches or feelings without using what you've learned from your mistakes, you're essentially gambling, you're not investing. Leaders make decisions. Having the optics and pertinent data to make those decisions is critical. This is what a great business owner and investor does. With that said, you won't always have all the data you need to make a great decision. And I do believe in real estate there's a place for instincts and intuition. Sometimes you can feel an opportunity arising, either a great market that has strong growth potential and momentum, but hasn't really been tapped out yet, or a seller has potential in a property that really isn't fully transparent to others, or a partner might bring much more value than just capital. They may bring valuable experience or expertise or relationships in your business. Even employees or managers can add a lot more value than you ever expected, and you just had a feeling that they were going to be a good fit for your company. I definitely believe in listening to those signs and signals that tell you to move forward on some opportunities and partnerships, and at other times trusting your instincts when it just doesn't feel right to do the transaction or work with that particular person. This is more of a function of how to read people and understand how their talents and their demeanor fit into your overall plan or even your overall lifestyle if you want to work with that person. If something feels wrong, trust that feeling and investigate it. Find other solutions in case an investor drops out or a lender changes the terms last minute. Or you just need investor capital so you can make the physical improvements. Have a contingency plan lined up so you still will succeed if something goes sideways. Because challenges will come and you will feel uncomfortable, and you gotta push through those in order to elevate yourself as a professional. If you're fully committed to the business, then there's no room for stalling, vacillating, or hesitating. You don't want to walk the decision tightrope. You're playing with fire because I believe this is one of the worst decisions, the lack of making a decision. You're wasting time, energy, resources, not only for yourself, but for the people in your organization, your investors, and all the other parties involved. You'd be surprised how many people get caught up in this decision-making trap, especially as the stakes get higher. People get nervous and they hesitate and waver because they don't have a clear plan or vision for their business or their investing strategy or the particular property that they're evaluating. And you can see then they search for distractions because they don't want to move forward and actually make the decision. Don't look for perfection. There'll always be issues. Just do the best you can in order to make the best decision you can with the information you have at that moment. Then don't worry about what might have been. Leave it all behind you. Learn from the past, push forward with a clear mind, have no regrets. There's no point in thinking I should have or I would have. You act and you learn from these actions. I believe walking this decision tightrope and always holding out for the right time to make the best decision is dangerous. Also, playing with fire in other ways on too many deals can end up biting you. For example, these are some of the fires you got to look out for. Making too many low money down deals, especially on assets that don't generate enough income to cover the debt payments. This will catch up with you quickly if the market turns. Debt can be your best friend or it can be your worst enemy, so be careful using highly levered debt. Waiting for the absolute highest point of the market to sell and risking the possibility that you'll miss your opportunity to make your money at all. So you can't time the market, no one can. If you can get a good value and execute on your plan, sell. No one will ever pick the top of the market. Being too aggressive and raising your rents well above market rents after you close on the property. So you could drive too many of your tenants out of the property and they'll move out and this will jeopardize your income stream. So don't be too aggressive on those rents. Putting up all your operating cash into one deal, leaving no reserves for unforeseen challenges. I've made this mistake. Do not put every single dime into the down payment. You have to have a buffer and some cash in the bank so you can operate the property. Counting on only one partner to put up all the investment capital on your partnerships. If they decide to change the terms, you won't have time to find another investor and they might leverage this power when they know you need them. So have multiple investors if you can, have multiple people that will put cash into your deals because it's the law of human nature. If someone has leverage on you, they're probably going to use it. So these can be fatal flaws in this business. Make your decisions with conviction. You can definitely be too much inside your head, going back and forth, questioning if this is the right thing or the wrong thing to do. After you've done the work, dig down and feel the power and strength in your gut to step up and decide what's right for you and your investors. This is where you can take control of your mind and your mind doesn't control you. Relying on your gut allows you to take risks that are calculated, not reckless. You may need to stretch going out on a limb, especially if you don't have a lot of resources in the beginning, but there are many moving pieces to this game. If you fail, it's a long road to get back to the top. Trust me, I know. So know where you can lose, sacrifice upon, and that loss won't be fatal to your overall investment or plan. It took me 10 years to recover and have the ability to actually get a commercial loan after I incurred a bank foreclosure on one of my residential properties in the 2008 crash. Looking back, my investment plan was weak and one-dimensional. Buying single-family houses like everybody else, fix them up, and then sell it to a higher bidder. We've all heard it, fix and flip. At the time, the rental income couldn't even support the mortgage debt if I was forced to hold on to it. And since the market dropped in half in Las Vegas, I was forced to hold these assets. That was a careless and silly mistake, but I learned my lesson from it, and I'll never get stuck in that type of single-family home investment again. Just like in dating, never be in love with one single deal. Good deals come and they go. There'll always be another one, no matter how bad it hurts when you feel you missed out or lost on a great opportunity. If deep down your intuition tells you to walk away, then walk away, period. There will be moments, especially in a hot economic market, where negotiations will get out of hand and bidders will push the property price well above the value you should pay. You must be disciplined to move on the next opportunity. There's no room for ego in this business. You will lose. If you play the game long enough, someone will surely come in before your offer contract is signed, and then they'll bid up the price, pushing your offer out of contention. So know the intrinsic value of the asset, know your company's competitive advantages, and then be disciplined and make the right move. This is a necessity when there are many people counting on you. Don't forget this important point. Just because the highest bidder won the negotiations in that moment doesn't mean the deal will necessarily close. Many commercial real estate transactions don't close. If it's a deal with the right ROI, then continue to follow up with the seller or their attorney and don't worry about the rejection. The deal can easily be back on the table if something doesn't work out in that transaction. If you continually have opportunities in front of you and you build your relationships by persistent follow-up, you will win in this game. In the end, the person with the most power is the one that has the least to lose. And the person who has the least to lose is the person with the most options and flexibility. The more you work at these fundamentals, the more power and flexibility you'll have. Decision-making is like a muscle you must exercise. As I get more and more experience in my career, I get better at making key decisions. I've practiced continually by being in situations where I had to make decisions with a lot riding on them. Knowing I have this power, this ability to weigh the options and make key decisions has given me more peace of mind. I haven't always made the best decisions, but I understand why I did what I did. I realized when I made a mistake that I'll learn from it and then I'll let it go, knowing next time I'll make the best possible decision I can with the information that I have. So in needing to make lots of decisions, especially when you're starting from nothing, I'm sitting in this booth here, I'm doing the audiobook, and then I'm going to walk outside and I have about 50 voicemails I got to get back to, and I got to make a lot of decisions, and there's probably a lot of issues going on in the company. And in this business, if you're coming from nothing and building something significant, you got to be okay with that. So you got to be okay handling things on the fly, responding quickly, making decisions and allocating the cash that you have at hand or the relationships that you need to forge or sever and get rid of. And this really taught me to take my time. So some decisions need to be exercised immediately, and other decisions, the big ones, you need to exercise being patient and taking time to make those decisions, especially if you're going to be selling or refinancing or entering into a new deal. So making good decisions means controlling your time. You set the timeline. You can make a conscious decision about what your next move is going to be rather than just reacting or scurrying or frantically making a decision because someone boxed you into that timeline. Revisiting mindset, desperation versus abundance. Trusting your instincts and creating good relationships puts you in the best possible situation to be successful in every deal. You're not scrounging for scraps on the ocean floor or overpaying for shiny, sexy properties that look good in your portfolio but add little to no cash for you and your investors. Adopt the mindset that deals are always out there and they'll always be in abundance. You always have the power to choose the good ones and let the rest go. When you have prolific deal flow, it's easier to feel like things will just work out. A good program generates a predictable and consistent flow of opportunities, which equal having the power to choose in an abundance mentality. It's like you put on a pair of glasses that give you a 20/20 vision. You have complete clarity when you're looking at each unique property's characteristics. Ultimately, it gives you the confidence to walk away from a bad deal without any regrets. I don't know if you remember when you were dating, but it feels a lot better when you have a lot of different people to date rather than that one person that you just have to be with or you have to go on this date with. You don't want that. Scarcity breeds desperation, and desperation causes people to feel uncertain. If the parties in a transaction get nervous, you jeopardize the deal. So that scarcity creates the feeling of people being uncomfortable. It could be the seller, it could be the bank, it could be that person you want to go on a date with. It just breeds insecurity, and they feel uncertain from your insecurity. So if a seller finds out this attitude, many times they can't help themselves. They'll be greedy and try to take advantage of you in that situation. They may try squeezing every dime out of that transaction by looking for ways to raise the price, eliminating the favorable terms, or finding any other way they could to renegotiate the contract. Once your terms are in writing, the seller can't materially change the deal without a lawsuit. However, if you're in a vulnerable position, such as needing more time to close or you need time to complete your inspections, they'll dangle the idea of pulling that deal away. At that point, they've got you by the balls. You then have no leverage because the seller can see that you want something so badly, and you'll start to make bad decisions so you don't lose it. Somehow, this is the law of the universe, right? And people can smell it on you when you need something too much. The less attached you are to your desires, the more things tend to work out. Never get too high or low or attached. Stay grounded. Listen to that inner voice that doesn't waver. Your logic and intuition can assess the situation better than your fearful, over-analytical mind. Remove emotion from the process. In the end, no matter how much you like the deal with the people involved, the numbers have to work. The due diligence process. So the following is a summary of what's involved in due diligence. This helps me make sure I have the information I need to confirm the property's cash flows, the state of the infrastructure, the value-add opportunity or business plan, and this is what I use to make sure I'm not getting ripped off when I'm buying a property. This process begins when you give the earnest money deposit to the escrow company or to the attorney, and once you have a fully executed purchase agreement, you need this detailed checklist so you make sure that you're covering all your bases. This checklist is available on patriotholdings.com/resources. So I can't emphasize how important it is to confirm the financials. First and foremost, you have to follow the money trail. You must see the cash flow, the income, the revenue. If you're buying an investment property, you need to see the actual cash, the income hitting the bank account. This is the bottom line on the financials. And there's numerous other inspections you need to get when buying a property. I don't want to outline them here on the audiobook, but I'll highlight some of the most important. You must get an environmental inspection. Get a Phase 1 environmental inspection that will tell you if there's contamination on the property or not. This is a non-negotiable. You do not want to buy a property with contamination that you don't know of because you're responsible for it. Number 2, get an ALTA survey. ALTA stands for America Land Trust Act Survey. It's the highest standard of survey where the surveyor will outline the property boundary lines and any easements, encroachments, entitlements, anything that's encumbering the inside of the property. They're going to put that on the survey map. This way you know if there are any restrictions that limit the use of the property. Get an ALTA title insurance policy, which helps ensure that you're getting free and clear title. Call the town zoning department and make sure that the zoning is allowed for that use that the tenant or the property is being used for. Get a physical property inspection. They're called property condition assessments, and companies will go out and physically inspect the property for you. Look at the rent roll and the leases. This is where a lot of funny business with the seller can go on. You need to make sure that the actual tenant that they're stating is in the space is truly in the space paying rent. I've seen times where no one's in the space, yet they showed up on the rent roll. You didn't get a clear cash flow picture because they were misleading you on the rent roll. So if anything appears to be dramatically out of place in your third-party inspections or with your financial analysis or with the physical due diligence results, you can always go back and submit a clean new offer during that due diligence period. If you communicate these issues to the seller or their attorney with clarity and conviction, many times it will yield better circumstances than the original offer. Don't let the seller back you into a corner because you feel afraid to lose the deal. If you're working with someone who has a motivation to sell, which you should determine from the beginning of the transaction, then keep in mind that you both want to get to the finish line, so there's always a way to find a compromise to make it work for everybody. If there's a serious issue, the seller should be expecting a price reduction to the offer and some new terms. Make sure they understand how the due diligence findings affected critical aspects of the deal. Now, if you're on the selling end and the buyer comes to you and tries to renegotiate the price and doesn't have any valid reasons for doing that, then you have the ability to cancel the deal or get that earnest money deposit if they decide to move forward after their due diligence period. This is something in real estate we call the retrade. This is a nasty technique where the buyer will wait to the very end of the due diligence and then they'll ask for a renegotiation on the price to the seller once the seller has already counted the money in the bank. They're expecting that money and they're using that against them so that they can get a better deal for no real reason. So it's always a good idea to have a backup offer in place. And while the buyer's buying your property, check in, make sure that they're getting their inspections on time. And if it's at the end of their due diligence period and they haven't done any of those inspections, be ready for a retrade because it's probably coming. Chapter takeaways. So the time you spend evaluating each deal provides insight and intuition that sometimes can be easily ignored, especially if you forget to maintain the mindset of abundance. If all the signs are telling you to walk, no matter how good the deal looks on the surface, you must walk away and know there will be another. Know where your limits are. These are the tipping points beyond which a good deal becomes a not-so-good deal. Especially if circumstances or timing make the deal more important than it otherwise would be. Say you had a taxable gain that you're trying to shelter, or you have an investor with a lot of money that you need to place. You don't want to overlook these signals that maybe this isn't a good one for your specific situation right now. Always keep in mind what your ideal price and terms would be and how much you're willing to pay to compromise to get them. If something feels wrong in a deal, trust that feeling and investigate it. Make sure you have other solutions in case an investor drops out, a lender changes terms, or you need a little extra capital to make the improvements. You don't want to have all your hopes or eggs in one basket that one person or one deal or one seller is going to dictate the future of you or your company. Set up checklists and systems. Trust the key team members who support you in the process and then follow through with conviction. Part of trusting your gut is doing the research you need to fully understand the potential an asset has within a local market. Know the market rents, know the market occupancy, and know the quality of the competition. This will give you the power to make the right decisions so you know exactly how much value you can add. As a leader, entrepreneur, or business owner, your communication skills and your decision-making abilities are the most critical skills you'll need to be effective and successful in any endeavor or venture. These skills ultimately allow you to build lasting and valuable relationships that endure over a lifetime. Final thoughts. Commercial real estate allows tremendous flexibility and creativity in how you structure deals and partnerships. Be flexible and receptive to new approaches and strategies. Remember Scott Shields' wisdom. I'll pay your price if you give me my terms. And at the same time, don't forget the fundamentals. Read Rich Dad, Poor Dad and learn to think like a wealthy person. Whether your goal is to be an active or passive investor, be knowledgeable about your industry. Self-education was a big part of my success. Knowing how capital gains taxes worked and being able to explain seller financing options helped me solve the seller's problems, and also I sounded confident. Never fall in love with a property. Sometimes the best deal you ever do is not doing a deal when the market is not conducive to it. The background research and being aware of the condition of the local market are critical before you go ahead on any deal. Never buy a property in a declining area. No matter how much you fix the property, you can't fix the market. Understand, you may not be successful with every deal. I became less inclined to invest in properties in regions where disasters were more likely to occur, such as a tornado zone, because I've had past losses. When things go south, do your best to make sure the other parties are happy, even if it means a loss for you. That's one way to salvage something good from a bad situation. You could get a good reference from that experience and cement a relationship by protecting your partner's interests. Relationships are a long game, while profit can be made on any other deal. Understanding the paradox of cash. Cash is king in down markets. If you have the knowledge and expertise to capitalize on opportunities during those times, You can make a lot of money in real estate when everyone else doesn't have access to money, but you have cash to go take down the deals. These opportunities only come along every 7 to 10 years, so it's critical you understand what you're doing and why you're doing it. You must be able to objectively evaluate an asset in good and bad markets and understand how to unlock value, taking your emotions or fearful thoughts out of the equation. In up markets, leverage, also known as debt, is king and the key to growing your wealth. However, one part of the long game aspect of real estate investing is being aware of those business cycles and using your intuition to know when to prepare for a potential down market. You don't want to be over-leveraged if the market starts to slide backwards. I sold some of my portfolio in 2019 to access capital as a cushion against the unknown. I've been building relationships for 2 decades in the business, which provides another source of capital when I need it, other people's money. Also understand that you are not a slave to your investors. You're a steward of their money, and you add tremendous value to their lives. Take it seriously and embrace this powerful responsibility in your partnerships. Cash can also be trash. If it's sitting in the bank, inflation is eroding it away. Make your money work for you instead of you working for it. Consistently look at investment opportunities, learning and refining your craft, and calculating what investment decisions are best for you. If you're looking for investment returns that are better than the stock market averages, looking for cash flow, looking for tax advantages to offset income, then alternative commercial real estate offers a better combination of benefits than any other type of investment. Every investor in every private equity fund has a unique strategy that works for them. The methods I've been refining over the last 2 decades to grow my own portfolio are the ones that I'm using to make the funds at Patriot Holdings successful now. I have absolute proof they work, and it's in my track record. Understanding my successful strategies can help you find success in your own investing, whether you want to grow your own portfolio or invest in a syndication or funds. Understanding and applying the 6 Edge principles in your own life can help you find the best path to success for what you want to achieve, so you can find your own edge in real estate. What will your legacy be? There's so much going on in the world, so many challenges and issues to face. It's easy to say, I don't matter in the big scheme of things, the world's going to do what it's going to do. Yet no matter how small an action you take, it does make a difference to the people around you. Your actions matter and my actions matter. Living with a sense of purpose, being kind, being compassionate and empathetic to others, and giving a helping hand when I can, that really matters. Being a person of my word and someone who can be counted on matters. Trying not to make too much of a mess in the world and trying not to overconsume and frivolously wasting things matters. Listening to and loving the people closest to me in my life, my family, my friends, my colleagues, and partners, it matters. What I'm really talking about personally is I want to ultimately help people and ease their intense suffering. I don't have a huge cause to back, nor do I have a large family that's going to inherit my wealth, so my 4th quarter will likely be focused on philanthropy. I'd like to continue to donate resources to help the world get fresh water, and I'd like to contribute to my community by developing a series of beautiful public parks and supporting libraries. My goal is to build a series of parks in my hometown of Las Vegas or where I grew up in New Hampshire or anywhere I can help in the country. This is the one place where I can leave my community better off than when I got here. Being outdoors and enjoying nature is one of life's greatest joys, and it's one I want to help others enjoy long into the future. I want to add value in meaningful ways, and I want people to feel connected to the earth and nature and the world around them. Hopefully in 20 years, I can write a follow-up book on the 3rd and 4th quarters of my career so you can see how they panned out. Certainly, there'll be many more lessons to learn. I'm sure I'll continue to make mistakes, but hopefully I'll have parks and libraries spread throughout the country, and I leave this world a better place than when I got on it. Epilogue. In the past 5 years, I've experienced some tremendous growth and success as a real estate investor, and I can't complain at all. At the time of this audiobook, I'm almost 42 years old. I started writing this book 3 years ago, and I've been working my butt off for about 20 years in real estate. I've finally been able to treat myself to a condo in San Diego, a beautiful house in Las Vegas, and I have the freedom to go back and forth and travel and do as I please. It's hard to express my gratitude for all the love from my family and closest friends. I wouldn't have the confidence and faith in myself if it wasn't for the care, the support, the attentive love of my parents, my grandparents, my aunts and uncles. No one learns how to succeed in a vacuum. Everyone gets help from someone at some time, and I'm blessed and thankful for all the support and the teachers around me. The challenges I've overcome and the people who are in my life have been the most valuable teachers for me. We still live in the most prosperous, exciting time to be alive in history. So many changes are upon us. Wealth, opportunity, technology, and access to information are all growing exponentially. It's important to be aware of what's wrong with the world, but it's also smart to look at what's right with it too. So during the first quarter of my investing game, I was trying to find my way. I used to watch planes flying in and out of Las Vegas, and I'd be excited, imagining all these places I'd go to in my lifetime, all the business that I do. I'd get to see new places in the country, new opportunities, meet new people, create big partnerships. This is what excited me. I don't ever want to lose that sense of adventure in business, the thrill of it all. I love playing this game, and I'm going to keep playing it for the rest of my life. I can't imagine waking up every day going to an office and hating what I do. I enjoy the game for what it is, and it isn't about material possessions or getting lots of money and showing off. It's about winning. It's about putting my best effort out there every single day, learning, evolving, growing, and then I'm going to take what I learn and I'm going to continue to write books and put out content and share it to you so you can learn it too.